Hey everyone, so I had the opportunity to interview Gary Norden and I had so much fun doing this interview. I'm really excited to show it to you. So I'm just here the weekend before the video is going to go out and I was thinking maybe I could pare the video down or split it up into multiple videos, but Gary just says so many great things in this video. I really think you're going to want to watch the whole thing. So just to warn you, it is 2.5 hours long. I'll have chapters down at the bottom so that you can see what the different parts are, and the stuff about his course, which is what I think most of you are going to be primarily interested in, is at the beginning, but he says a lot of great information just about trading in general. So I think you guys are really going to like it. Enjoy. All right, there we go. So welcome and thank you very, very much for doing this. So for those of you that don't know Gary, he is probably, when you're talking about people that have made themselves available in the retail space, I don't think that there is anybody more qualified to talk about things like market making than Gary. I mean, obviously there's lots of great traders out there, but Gary is one of the few that has actually come and shared information with us. And I think that his credentials are just unparalleled. And he's been putting together an education course, and you know, I am just like a guy with a YouTube channel. Nothing really special, but I've always been a really big fan of Gary's stuff, and people talk about it on my live stream a lot, and it's kind of, there's a lot of crossover because a lot of the people that I'm trading with are doing things similar to what Gary teaches. So when I heard that he was putting together a website, an education course, I was really, really interested and asked if I could talk to him about it, and here we are. So thank you very, very much for doing this.
No worries, Seth. My pleasure. Nice to be on.
Yes. So I want to know, what was it? I know that you had a course before that was available through Jigsaw. What kind of prompted you to expand and create a new course and go at your own and everything?
Yeah, so there are some sort of issues and reasons why I needed to um, move the existing course away and to put it under my own compliance regime. When it was apparent that had to happen, I really took it as an opportunity to really have a look at at what was being offered, have a look at the feedback that had come in about the way that course had been presented, and then to think more about, okay, on this new system and on under my own compliance regime, but also on using the learning management system that we're using. It just enabled me to do a lot more. And around the same time, I was also talking to some people, some ex-floor traders and people in the industry. I just started to put this picture together that I can do so much more now, and particularly with this learning management system, um, that I could build something that was, as somebody sort of said to me, it's kind of like a legacy project. You can build something now, and you can put all the things you've been thinking about doing for maybe a decade and all the things that you haven't done. Um, to put that out there now, and particularly ex-floor traders, talking to them and knowing that that what they've been through and the feeling that these skills are being lost. This is an opportunity now, as I say, like a legacy project, as someone called it, to put these ideas out so that the ideas are not lost, because they're still very relevant. It's just that there's not many of us left that have these skills. And that's why the new site is far more comprehensive, and really, I'm really pleased with what we've done. And it's also about the pathway that we took. It's not just about the course itself, it's the pathway. Because when I went to now have a deeper look at, okay, well, what separated, what happened in my trading career, what are the steps, what are the processes that I went through, and other like floor traders or bank traders, because I actually started my trading in a bank, not on the floor. And what I'm trying to do is replicate that pathway as well, and there's other steps in that pathway than just the courses itself, so I'm replicating that on the new website too.
Okay, so for those people that are familiar with the education materials that you've put out in the past, what are some of the new things and information that they're going to be able to find there that's different?
So obviously the main courses themselves are along the same lines as, for example, the manual that was on Jigsaw. It's just that now I've been able to expand them further and put them more graphically. And I should add that if any of your viewers, bought the manual on Jigsaw, I will give them free access to the equivalent course on the new site. So, they're not going to lose out. I'm going to, those people, if they just have to, show me that they're proof of purchase, and that's fine. I've said to anybody that's bought the manual, you'll get access to the new course. So on the learning management system, I'm able to make it a lot more graphical rather than just documents. It's a lot more graphical. We've put designers in, and there's also a version of it with there's over 40 narrated videos. So that's never happened before online, where there's dozens of videos. So if I'm talking about a concept, that the major concepts, some of them might have 4, 5, 6 videos that back that up, so people can see what that might look like. Which is something that people have always asked about, and I understand that, but before there was never really a way of putting that out there that would protect the content. But on the learning management system that we're using, there's a way of protecting that content. Okay, so that it can't just be replicated. People just can't just sort of share the screen and put it on YouTube, because their email address comes up all across the screen. So it's good in that way, and that's protecting this is important. And I'm sure people, if you buy the course, you don't want it to put it out there. So that's one thing. But the actual pathway itself is something that got me thinking, because if I look at floor traders and the pathway we took on the floor, but also in banks, one aspect of what we did was to be tested. So, for example, when I went down to the floor to become an options market maker, I'd already been a market maker for a bank for 2.5 years. Um, so I think I was pretty good at what I did, and I think I knew markets. I knew how to make prices. I knew how to, to be a professional operator in amongst, other investment banks. But when I went down to the floor, the thing about on the floor is everybody starts off as zero, as nothing. So the first thing you have to do is you have to firstly wear, a yellow jacket. That means you're not allowed in the pits. Doesn't matter the fact that I've been a trader for 3 years or 2.5 years at a bank. I still go down to the floor. I wear a yellow jacket to start. I'm not allowed in a pit. What do I have to do first? I've got to pass a series of modules, a series of tests and exams set by the exchange that firstly show that I understand this product. What are futures? How do they work? And then when I've ultimately passed them, I go in the pit and I get firstly a blue badge, and the blue badge says I'm a new trader, right? And I need to be supervised. So blue buttons, as they're called in London, blue buttons were only allowed in the pit. So they had their colourful trading jacket, but they were only allowed in the pit under supervision. And you had to nominate people that were going to supervise you. So, for example, if I nominated 2 people and they were out at lunch, okay, I wasn't allowed in the pit. Okay, so you had to be supervised. Until then, you were proved to your peers in the pit that you were good enough to now stand on your own. And at that point, you got the silver badge that said, okay, this guy's good enough. So there's a process there. And similarly, even in banks, you generally have to take exams. In London, I had to take the registered reps exam. I also, when I became a market maker of international equities, I had to go to the London Stock Exchange and take the international equity market dealers exam. So everywhere, before you're allowed to participate in a market, generally you have to take an exam, right? And now advisors take CFAs and whatever. But for retail traders, that barrier isn't there.
Right, right.
They just buy a course and trade. And so it got me thinking as well that that whole pathway is part of why I think that we're more successful. So in the new course, for example, on the new site, I have a yellow jacket course, and it's a basics introduction to futures. And I worked with a futures broker with that, because he said as well, his firm said they see people coming into the industry and they don't have the basic understanding of futures. They've seen a video, like an advert on telly, and they've got them
Right.
to a bought a course, but they don't actually understand aspects of futures. Like they don't really understand the expiry process too well and things like that. All these things are quite important. So on the new site, I have a yellow jacket course, which is free. And there's a test at the end of it. Okay. And the point with this now is that for people coming into who want to buy one of the sort of scalping style course, they can't do that unless they've passed the yellow jacket course now, the test. So there's an 80% pass mark. Um, so again, we set it reasonably high, but I expect anybody who's wants to trade futures for, in any kind of capacity should be able to pass that exam. So now you can't just buy, my course. I've set now this barrier, which is no, you have to take this exam. And I say the course is free, so there's no impediment there. It's a free course, but you have to pass that exam. And we've set the site up that unless you've passed that exam, you can't buy any of the other courses. So that's the first kind of barrier to start saying to people, no, we don't just want anybody taking this. We want you to have some basic knowledge first. And then I've introduced a blue button course, which is a relatively cheap course, and that's optional. People don't have to, but if you're a new trader and you're going through the process, I would suggest that people should take it. The blue button course is just a series of videos where I really talk about how markets work, how futures markets work, talk about the platforms, give the basic. And I'm doing that, mentoring that guy that I had to have when I first went in a pit. What's your role in the markets? Let's think about what we have. Let's think about our strengths and our weaknesses, which is what I happened when I went into a pit. I had a trader looking over me, experienced guy, who would say to me, right, Gary, the banks are coming into the pit. We can't play that game. This is our game. We're here as locals in the pit, and someone to guide me. So the blue button course is, as I say, it's an optional course. If people think that they don't need
Right,
it, they don't
right.
have to take it. There's no exam at that one, but it's really about me trying to tell people, explain what their role is, mentor them in those sorts of early years before they still. The idea is that you take this before you start trading. You start to understand what your processes are. So that's what I mean about recreating this pathway. I thought a lot more about what was the pathway we took, not just the skills themselves. And all this is about slowing people down as well, about, don't just buy a course and trade. It's go through the processes first. And then on the course, we have what we call the silver jacket, the silver badge, sorry, and the red jacket courses, which are the same course, essentially the market making scalping style, but one has video content and one doesn't.
Hmm.
Both of them also have exams at the end.
So,
So the silver,
so on the video content, because you've mentioned that once already, are we
yep.
talking about like live watching live market data and commenting on it, or
Yep. So we're watching trades, and there's some good trades and some bad trades. We're
okay,
watching, some of these videos are 4 or 5 minutes, some of them are 20 minutes. If perhaps we're watching 3 or 4 trades after each other and how we move from one to the other, there are different concepts. So if you think about, for those that have the manual, there are some of the concepts like value. We have a very specific way of working out a value of a contract, and there are a number of inputs into value. So that's one section now where there are a number of videos on value about, how do we judge value in a faster market, slower market? How do we see where value is moving? So now there will be a video sort of instructing that and showing that more. So yeah, that's what we're doing there, and then some other concepts. So one of my things is, talking about, for example, why we shouldn't be interested in highs and lows. And people get really scared about highs and lows, right?
right,
Because most people are trained in a kind of technical analysis way. And, I've always made this point that if you look at a market, grinding higher intraday, let's say, ES is up 1% today, right? It's been grinding higher.
right,
How many highs were there during the day? There were hundreds of
yeah, yeah,
intraday
yeah,
highs, and 99% of them meant nothing. And reality is, if you're going to be a day trader, you have to have that view that most of these highs are meaningless. The new daily high. Everybody's scared about, they don't want to be caught long at the top, but they don't want to be caught short because if the market goes through the high. So they end up in this situation. And if the market's grinding higher, it's just new high, new high. Every new
yeah,
tick is a
yeah,
new high. So they end up paralyzed. So I show examples in that about, as me buying a high, there's me selling a high, there's buying the low and selling the low, and I explain about what the processes are at all those points. So there are things that before people may have still have that, uncomfortableness about, and I want to show that if you go through the process, and a lot about, the courses is a process, as much as it's not an indicator, it's not a technique as such in terms of everybody's going to copy it and do the same thing. It's as much about having processes and making sure that process is robust. And if you go through the process, it tells you what you need to do.
Okay.
So that's the video content. As I say, there are exams at the end of both of those as well. So I've shown this out to people that I've taught and that. So as I've put that out there, and it's quite interesting. People that said, "Yeah, I understand what you taught, and I've read your stuff, and I know it. Maybe I've read the manual and I know it." And then you've got and said to them, "Okay, well, take the test," and we've put like a 70% pass on the silver badge test, and they've come in with 60% pass. And it's real, and even they've gone, wow. And again, I'm not a part of this is also not about making it easy.
Mm.
I know you can set tests and make the test an easy one so everybody passes. I haven't done that. I do not expect everyone to pass on the red jacket course. I'm expecting reasonable high failure rate. But I'm testing people because markets are like that. And it's not like, at school, when you have kids at school nowadays, everybody gets a merit award, right? At
Yeah.
school, everybody gets it's not like that. The markets are not like that. So I'm not doing that with this. It's like if I'm putting a test with the red jacket course, it's a 75% pass mark. It's 50 questions. It's, you'll have to know the course well to pass it, and that's what we want. And if you don't pass it first time, well, you can go back over the course and keep learning it. But that's what the markets are like. It's not just, oh, everybody wins. That's
Yeah.
absolutely not what the
I,
markets are
I,
like.
I
So
really like that because markets are competitive, and in a competitive game, like there's kind of like a minimum bar usually that's like, if you don't meet that minimum bar, then you're not going to have fun even playing the game, you know. So I really
yep,
like that.
exactly.
So for these courses, can you tell us now what the prices are going to be roughly?
So as I said, the yellow jacket is free because it's going to be a prerequisite for any of the others. You
Right.
can't buy any of the others without doing it. The blue button course is $295. I can't tell you exactly how many hours of content there are on that one, but it's all video content. The silver badge course, which is essentially, it's kind of like an upgraded version of what was in the manual. There's a lot more. I also talk about some of the reasons behind this and some of the stories from my career that made me create these rules and techniques. So that's all in there as well.
Okay.
There are a few videos with that one, but not many. That one is 12.95, and the red jacket course is 27.95.
Okay.
And I'll say something else now. That with the red jacket course, the other thing is that if you pass the red jacket course, the red jacket test first time, um, I will send you a red trading jacket.
Oh, there you go.
So I've had made in Chicago, by the trading jacket, one of the best trading jacket firms with my logo on the back. So we're calling this the Norden method. So it's a Norden method logo on the back. I will send you, wherever you are in the world, your very own red trading jacket. Because one of the themes coming through here that I want to sort of point out to people is that when you trade with your own money, you are essentially a local. In the pits, people that trading with their own money are locals. And what's kind of happened is that people are trading from home, but they're still trading like retail traders. And I want to make them have the mindset that, your mindset should be you're a local.
Right.
You're trading with your own money. You should trade like a local. You should think like a local. So the red trading jackets are kind of a way of showing you, kind of reigniting the idea of a local, of people trading with their own money in a professional way, in a different way, acting like market makers in the flow. So that's what, I'm saying. Well, if you pass that exam first time, you've done well, and I'll give you a red trading jacket, and you can consider yourself a local. And one of the futures broking firms, or one that I'm working with, I think are going to sort of offer some incentives to those kinds of traders, because their view is, well, if someone's taken this course, they've seen the course,
Right.
and they've passed that exam and got the red jacket, we're much more happy to have that sort of person as a client. That kind of style of trading, if they've passed that. So there'll be, I think there'll be incentives, through stage 5 as that broker to help,
Hmm.
towards those people, which I think is great, right? I think that because technically they should be better, quality traders for them.
Right. Right.
So
I really like the idea too, because one of the things that bothers me, because I started at a bank. I mean, I didn't trade for a bank. I was in technology, but I saw enough to see the culture, and in that bank in particular, there was very much a culture of like, they didn't want to document things. Nowadays everybody has like a wiki and all the information on the wiki. They didn't want to document things because they wanted to force you to talk to people so that you would pick up the culture. And I feel that now in the trading world that what we would call the locals, like all of the day traders, are kind of at a disadvantage, in part because we don't get that culture. It's like, the big firms and the banks, they have like complete control over everything because the other side of the market is clueless. And so I really like that idea of, like giving them a jacket and, imprinting upon people that local culture, so that they at least stand a chance or understand what's going on,
Yeah, absolutely. And I know from my pathway that if I hadn't have met with, on a personal basis, some great traders, and also, to be fair, seen firsthand some rubbish traders,
Yeah.
I wouldn't have been able to learn these things. And that was another part of the culture that at every bank I worked with, in some way or another, I trained traders either during the trading program or by having assistant traders alongside me and teaching them. And that was very much a part of the floor as well. You had your clerks, or clerks as we call them in London, but clerks because you're American. So you'd have your clerks. They were usually young kids, and usually after some time of working with them, you would back them and put them in the pit. There are many firms on the floor, perhaps in London, people like David Kite was one of the preeminent ones there. Start with a small firm, ends up with dozens and dozens of traders in pits backing them, and you bring in some traders, you train them, and then as they get better, they train the people below you. The idea of training people was very much part and parcel. The idea in London in particular that this is a trading hub of the world. If we're going to keep London as a trading hub, it's incumbent on every trader to teach people, some of the skills. And, I'm sure that, we'll get to, and your people will ask me questions about, well, yeah, but, if you teach people your skills, doesn't it mean that you don't have the edge? Well, no, because everybody's going to use it slightly differently, and we're all slightly different anyway. So there was never a view that, oh, I'm not going to train people because if he comes into my pit, he's taking business away. All of the firms with locals, had, some of them, there were groups of 3 or 4 in pits, and actually it would help you. And if I look back, I wasn't a particularly good by any means options market maker in the pit. That's probably my weakest part of my trading career. And one of them was that I didn't I went out into pits on my own, and after and I didn't really have that enough help to put these pieces together. I kept having to try and do it myself. So the idea of training people is very much part and parcel. And of course, it's different where I came from because when you're alongside people, you knew that whether they were good or bad. And I know it's very hard for people, you know, just going through the internet to work out whether someone that's teaching has really got that experience and whether they're good or bad or whatever. So um, yeah, finding the culture, and now even in banks and hedge funds.
Mm,
The first year, there's not that many traders
right.
anymore. They're mainly concentrating in flow. And secondly, now I've taught one of my one-on-one clients, for example, came out of Citadel, and was a futures trader at Citadel, but really they're just execution traders.
Right, right, right.
The traders, they're not really trained to understand markets as such. They're trained to execute. Execute the algorithms or whatever it is that they're told to do. So, I was a little bit shocked,
Yeah.
really, because the training programs are very different. But when I saw him and I knew his background, I was quite frankly a bit shocked that many of the techniques that I thought he would know, and that's, I said to him, I think you're going to know a lot of what I'm going to teach you, but he didn't, because they're not trained in that way. They're just really taught to execute.
Yeah,
Um,
that it's interesting that you say that because that's something that I've been thinking about a lot because I've been getting a lot into optimal execution. So, like when I was at the bank, I had a few opportunities to talk to traders, and they told me a lot of things that I really didn't understand at the time. I think the most useful thing that they taught me was that, the market is competitive. So you can't just go and say, here's this pattern of this thing that happens all the time because everybody's going to go and try and get in on it. But when, the things that they were talking about, then when I went off on my own and I started doing research and I came along them, I was like, oh, That's what they were talking about. And I was realizing that most of what they were doing was like optimal execution. It was like, I have a really big order that I need to fill for my client. How can I execute that order in the most optimal way to minimize my impact on the market and spread it out over a certain period of time? And it is very different from
Yep.
knowing what direction the market is going to go, or realizing that there's an inefficiency there that you can take advantage of.
Absolutely, and that's really the one of the, if not the key skill set that you learn when you're trading for a bank, is how do you execute these orders. And I say to people that this is one reason why I don't agree with the many order flow styles that are out there, which are talking about working out what the big guys are doing, and you work out where the big order flow is. And look, these big when you're working for a bank and you're a big trader, you are just working out how do I execute these big orders. And that brings in all sorts of different methods, and it depends on the sentiment on that day, what you're doing. If you're trying to buy on a strong day, you're going to use different techniques to if you're trying to buy on a weak day. If you're trying to sell on a particularly strong day, you'll use different techniques. Sometimes it depends on whether you have an order as such, or whether you actually made a price and just got filled. Okay, as well, they're two different things. What I'm saying is that your techniques are very different on
Right,
different
right, right.
days. So the idea that someone can sit at home and work out what these big guys are doing, and somehow use that to make money off of, I really just don't agree with it. I keep saying this, to people, that trying to work out what the big guys are doing, and then work out, oh yeah, they're buying, so I'm going to buy it.
Hmm.
It's a mug's game. The statement I always make is, if you can really work out what a big trader's doing in a market, either you're wrong or he's rubbish,
Right. So let's
right?
get into that a little bit more, because so for me, because I think this is something that I've struggled with, like, and this is kind of getting into the whole technical analysis subject, because when I started, I had it's too far over here, but I have the technical analysis of stocks, and that was like, okay, this is how I'm going to learn how to trade. And then I just talked to the traders at the bank. They didn't know any of that stuff. They knew more about patterns. They didn't know what ahead and these different price patterns were. That didn't matter to them. And that was the first thing that made me go, okay, well, maybe technical analysis isn't as useful as I thought. And then when I got on my own, I got into a lot of the order flow stuff, and reading your own book, that kind of got me to realize, well, technical analysis isn't really very effective. But what I found is like two things. Was that, like, one, you'll start using technical analysis methods without even realizing it, right? Like, I've been noticing lately, there's been these big sell sweep orders that have been coming into the S&P 500, and it's like, well, they come in and the market ignores them, and so I think that overall you're okay to just ignore them and buy them, right? But then today, that is not what happened. Today, they came in, and the market really struggled after that. So there's a perfect example of, well, you're trying to use the past action to predict what's going to happen in the future, and the situation might be different. So there was that side of it. But then the other side of it was that I realized that what I was doing was I was taking order flow methods, and I was applying technical analysis to it. And
Yeah.
I've kind of changed more recently, because while I do think that it's possible that you can, go and find a pattern in the market, although it would have to be a very sophisticated pattern to still exist, right? But you can find a pattern that could persist, and if you size it right and everything, it could be something that's consistent. But overall, that's an extremely difficult game to play, you know?
Yeah. Yeah. Yeah, I mean, you've raised a lot of points, and they're all very much, I think, in line with how I think a lot of people found the markets. And we're humans; we like patterns. We like to think there's order in everything around us, and we're trying to find that order. Um, but I think that a couple of things. So you're right that the traders in the banks are not worried about not looking at these sorts of things. And I think with the processes that I put in place, excuse me, particularly for day trading, right? I think this is more for day trading than anything else. but it still is important for other styles of trading, is to, number one, understand that there is randomness in markets around us all the time. Somebody can put a sell order in right now, and depending on what the order book looks like, if you put it in 5 seconds later, it would have a very different effect. Okay, so to understand that element of randomness very much comes in, and what happened may look like something's happened, but in fact, if that had just been 2 seconds different, kind of sliding doors moment, it would be very different in the market. So understand that randomness persists, or and is always happening potentially, is always a possibility, and that as day traders in particular, that affects us more. But then have a process. Key thing is to be in the moment, is to trade the now, to not be aware, not make yourself aware of patterns, not to look for patterns, and just be in the moment. And the processes that are in my day trading courses are really about trying to get people in the now. It doesn't matter about what happened last time this was here, last time that somebody bought here, last time somebody's, which is very much, even some, and I think a lot of modern order flow methods are just a modern version of technical analysis. You know,
Right, right.
work out where there was a volume level before where someone bought and you buy there. Okay, well that's not being in the now. That's just saying, well, because this guy was here some time ago, he's here again. And in the new courses, I put in from my history why professional traders don't think like that. I actually put the examples in. And one of the examples is from Pitts. One of them is from, when I was trading for a bank, and explain how a professional would actually work in that situation. So, and I hope that by telling those stories, I'm actually explaining to people why you shouldn't care whether someone did this half an hour ago or an hour ago.
Right,
It's
right,
not
right.
really relevant. What you need to do right now is, right now, what's the right thing to do? You need to be in the moment, which, and there's going to be another part of the new site, which for those that have bought the courses, I'm going to have what's called the exchange, which will be a sort of community function, but not a forum. I'll have monthly
Mm,
get-togethers, and also put a lot more content on there, like videos that I'll create. And partly, there might be some reviews of books, but also get hopefully some other people in. And there's a lot of crossovers with sport, and if you talk to pro sportsmen, and I've trained some as well to become traders. The idea of being in the moment, of being in the now, is very powerful in sport as well. It's something that you just have to be in this moment. And I think that if you can be in the moment, in the now, look at what's happening now and respond to what's happening now, you are far less likely to use any of the other stuff, because that's all about using patterns from before and information from before. So,
right,
if you ask me what is technical analysis, or
right,
why do I
right.
classify
That's
order
what I
flow?
was about to ask next. Because,
Yeah,
well,
why do I classify order flow? Sorry, you want to ask a question? Sorry.
so I was gonna say, like, I was just going to go. I see a couple of schools of thought about what actually is technical analysis. Because one of the big problems that we have right now in retail trading is that there is so much as what you would term financial junk food that like definitions almost don't even have any meaning anymore. Something is only called technical analysis or not called technical analysis based on what you're marketing and whether the audience is prone to like technical analysis or not. And that's why I think that we have some forms of analysis out there, like price action, for instance, which is literally technical analysis for people that don't believe technical analysis works. And but for the really what I would call like the old school classic, the technical analysis of stock trends, technical analysis, they would consider that there is fundamental data and there is technical data. And fundamental data is like company earnings and all that sort of thing. And then the technical data is like everything that is generated by the market. So they would claim that if you are, for instance, let's say you're pair trading, like you're doing pair trading arbitrage, you're just using current prices to detect a temporary inefficiency in the market and you take it out. Because you're using market generated prices, they consider that to be technical trading, right? Whereas there's this other side that is like, is technical analysis not effective because it is the use of past prices, or is it the data that you're using, that it's the market generated data that it can only tell you so much? Or for instance, there's the order flow school of things that would say, well, the price itself doesn't tell you all that much, but when you combine it together with everything else, like the orders and the fundamental information and breaking news and everything else, then maybe you get a more complete picture. So that's kind of why I'm asking, like, what would you actually define as technical analysis, and what is it about that that you think is the most uh, influential behind why it's not very effective?
Yep. So, I mean, if we look at the traditional technical analysis and we look at the assumptions that underlie it, and there's a lot of people that are practicing this technical analysis, even classical, that don't actually know what the assumptions are. And it's really interesting. Sometimes I will ask them, but
It's
do you
very,
believe in
very true.
X? And then they'll just say, well, you kind of don't have to. I say, no, you do. That's the assumption. So, for example, the market is ahead is an assumption behind technical analysis, that the market is ahead. That that comes from the view that people know something. So when people are buying a stock, for example, it's because they know it's a good stock. It's going up, right? That's an assumption, and that's why you follow the trend, because if people are buying it and it's going up, it's because they know it's a good stock. It's going up. I don't agree with that, right? And I don't think many do. And if you don't believe me, then Soros talks about it as well. There's a competing view. So when we're looking at what's technical analysis, does the analysis believe, for example, that the market is ahead, that the people are buying and that's why you follow them because they know it's going up? So if you're using an order flow method, or a price action method that is based on the view that, okay, I can see lots of people buying right now, I'm going to buy. Well, that's using the same assumption, right? That the market is ahead, that they're buying because they know it's going up. Um, Now, why might not that be the case? What's the competing view on that? Well, the competing view, no, well, one reason is that not everybody is buying a stock because they like it. Sometimes they're buying it because they have to. Maybe they're delta hedging, for example, right? So there's, in this modern world of derivatives, there's a number of reasons why you buy a stock. Not just because you want to, because if you're an options market maker and you've just sold some calls, you're buying the stock because you have to. Yeah, the underlying people have bought call options, but do they actually know? Like, do you think that the people that are buying meme stocks are really knowledgeable about it? Different kettle of fish. So there are a number of reasons why people can buy a stock, and it's not just because they like it. The second view is that, which is the alternative view to the market is ahead, is that the market prices in. And that's the view that, from my time in the markets, that I believe is far more realistic, is that people are buying this because they think it's good. They're pricing in something. They're pricing in this is a good company. It doesn't mean they're right. They could be wrong. And sometimes they buy a stock and they're completely wrong. It turns out to be a pile of crap, right?
Right.
So, AMC was $70, $80 a few weeks ago. But that was that because people knew it was a good stock? No, it wasn't. They didn't. Okay, it was just a bit of, now it's at $30 or $40, right? So if you try to go on the trends and believe that, that's not how market, and particularly even more nowadays with these meme stocks, they're destroying the ideas behind technical analysis, and behind actually a lot of people's thought processes. That's why I think you have to be in the now. What's happening right
Yeah.
now? What's affecting this stock right now? And have that ability to pivot. But certainly the idea that, so if your style of trading assumes to some degree or other that what people did in the past either will be just repeated, or is a sign that, oh, they're buying, therefore it's going up.
Right.
That to me is a form of technical analysis, which is why a lot of order flow price action trading, I just classify, as you said, as technical analysis for people that don't want to say they're using charts. Because I think that the reality is that even experienced retail traders know that the chart patterns indicator is nonsense. Okay, it is nonsense, and it's
Yeah. Yeah.
the real shame was that when this industry broke down from pros and retail. So back in the day,
Yeah.
people on the trading floor and in banks were pros, people at home were amateurs. As soon as we get rid of trading floors and banks stop trading to a certain degree, and now the internet pops up, everybody's now a pro trader. And it's very hard to see, who's a pro trader. And it's in that vacuum that technical analysis grew. I mean, as you say, like in banks and on the floor, traders on the floor weren't looking at charts, right? As the market's
Yeah.
moving, right? Of course they're not. But the guys at home were the guys that they were basically able to make money off. But now it's much harder. So this vacuum, the technical analysis guys filled that vacuum very well. But certainly, I think that those that have been around this long enough know that all that pattern stuff is nonsense,
Yeah.
and you should avoid people that are talking about chart patterns.
But
But like
it,
you say, it's just another version has been brought in, and so it's about those assumptions. Are you assuming that the market is ahead? Are you assuming that because they bought before they'll buy again? Those kinds of assumptions, to me, are just another version of technical analysis. Sorry if that was too long.
no. Well. So would you say it's accurate to say that it's not just the use of past data that is a problem, but the assumption that all of the data that you're getting from the market actually has informational content that can actually be useful to your trading? Like you're saying that, like for instance, I'm thinking I'm interested in trading spreads now because we're going to have these new micro treasury futures, right? And
Yeah.
I'm going to notice at one point that the curve is steepening or the curve is flattening. And if I come in there and you make the assumption that, oh, the curve is flattening, that means something about what the market thinks about what is going on right now. That's it might be true, and there might be situations where that is true and that's helpful, but it could also be noise. And so making this assumption that everything that the market is giving you at that moment is 100% informational is still kind of running into the same problem, that really you want to be more making your own decisions because you know what something should be worth and what's going on and so forth.
I think so. Firstly, again, come back to being in the moment. So
Mm-hmm.
when a yield curve is flattening, there is, obviously the market at that moment, okay, is making some comment, but it's pricing in something. It doesn't
Right.
know that the economic situation is going to slow down or that inflation is going to fall. It's at that moment, it's starting to price in those things. But I think the key ingredient here is context. It's
Right.
contextual. Right now, with the information available at that moment, the market's doing X. Okay, but tomorrow an inflation number comes out and it's 8%. Well,
Yeah.
that's out the window,
Right.
right?
Right. Right. Right.
And all that information from yesterday, which is fair enough how they responded yesterday with the information available. But if you take the view that if an 8% inflation print comes out tomorrow, that market action could be off the table and we change, and you have to be able to change, with it, then the key thing then is that 3 days later, you're not still you understand that what happened 3 days ago was just contextual. That was what they were doing at that moment, and they created levels and lows and highs, but that was based on what they knew now, what they knew then, sorry. But now is a different time, so you've got to be in the now. What are we doing now? And
Mm.
people will still, so they'll draw their trend lines and they'll use that. Well, that was the low on that day, so that's where the market turned around. And what I'll say is, no, the context changed the next day. you
Right.
know so
Right.
there's no point in drawing conclusions or drawing lines or patterns on the basis of that, and it's just understanding that people base their decisions on the current context, and tomorrow that changes again. And the great thing for day traders is that they have, in many regards, the easier job compared to position traders, because if I'm trying to hold a position for days or weeks or months, there's a number of these changes are going to happen over that period of time. It's more difficult. But for day traders, the great thing is you should just come in. What's the market doing today? Sum it up as quickly as you can, and trade it. And then, as I talk when I train people, is get the Donny Brasco in here. Forget about it. At the end of the day, forget about it. Come in tomorrow. You're like a goldfish. And I say to people, when you're a day trader, you need to be a goldfish. You forgot what happened 15 seconds ago.
Right. 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 Right.
You're just trading now. What's happening now? What's happening now? And that's all you're asking yourself. And with, for example, with the style that I use and teach, it's where's value right now? Can I trade this market? Can I, where can I trade it to make edge? And
Right.
that's changing second by second. Second by second is changing. Where's value? So, the next morning you can come in as a day trader and there's a whole new scenario, new inflation print. You just trade that scenario. Just trade it. Forget what happened yesterday. Forget yesterday's low, because that was done under different context. It's not saying it's wrong. It's just saying that if those people knew today what they, knew yesterday what they know today, they would have traded differently, right? That's, we see like in earnings season, stocks are up 8%, down 9%. Do you think these people would have bought yesterday if they knew the
Yeah, if
company
they
was
knew it
going to
was, yeah.
miss? So they didn't. So now we have to completely, what was happened yesterday, off the table, right? Off the table. Let's start again. And the traders that can do that, for particularly day traders, okay, with position traders, their skill is working out what's being priced in and then working out what could happen. What are the potential outcomes? That's the skill of position traders. Oh, look at these people are thinking this. This is the scenario. What happens if they're right? Where could this stock go? What happens if they're wrong? Where could this stock go? Not just to assume they're buying, it's trending up, therefore it's going up.
Yeah.
Um, that's more complex, but that's the skill of a position trader, I would say.
Yeah.
Someone is holding for days and weeks.
Well, I like you say context because so share with something that I've been learning more recently. So there is a study by these guys with names that I can't pronounce, and so everybody in the literature they just call them GK because that's the names of the people that did this study. And the study is the inelastic prices are inelastic theory of markets. So this is essentially like a competing theory to the efficient market hypothesis. And when they went through and they did their analysis of things, they found that if you you took money out of the bond market and you went and you bought stocks with it, right? Like you just took $1 out and you bought $1 worth of stocks, that the net effect was that it actually increased the overall market cap of the total stock market by $5. So what they were saying essentially is that like the impact of individual orders is a lot more than what people expect. So, for instance, today in the treasuries, I know, okay, well, there's an auction today. And people usually they hedge. If I don't see them hedging, that might be a problem that, they're trying to still price in a higher interest rate. So that's what I was watching for, was like it's going to move down and there's not going to be very much volume on there, and that's my signal that yeah, they are going to do that and they're going to move down, right? Because and when they move up on very little volume elsewhere, if there's nothing happening at the time, if I don't have other news to attach to like why that happened, for all I know, like it's just noise. But as you were saying, when you're going through all of that analysis, when you have an idea of what's going on, like you saw a move and you knew that there was a big piece of news that was released then, or what the economic number was or whatever, and you can kind of attach these traders believe this and these traders believe that, then you can kind of filter out what is noise and what may actually matter, because the whole issue is that not everything that we see is actually informational. Some of it is just random.
Yeah. Yes, exactly. And not everything we see we can trade either. So again, with this market making style, one of the ideas is to understand that not just how to use spreads in trading, but understand which spreads offer you advantage and opportunity, and which spreads don't. Some spreads are good for us, some spreads are not. When you're a market maker in a bank, you don't really get that opportunity. And same on the floor, you have to basically trade on every spread. But on the screens, we don't. So I'm trying to teach people which ones are good, which ones are bad, which ones offer you opportunity. Yeah, and absolutely. I remember that technical analysis say that fundamentals are not important, company earnings, all that kind of stuff, not important. I mean, it's clearly nonsense. You have to look at what happens to a company after earnings, and to a large degree it's about what was being priced in. What was being priced in. Oh, it's surprised, right? Yeah, well, it surprised everybody, but these are scenarios where clearly the market, when you see a stock that falls after a strong rally leading into earnings, clearly didn't, and the company disappoints, for example. Well, that's clearly an example the market wasn't ahead. And it's only, you only need one of those just to prove that the idea behind technical analysis, and the ideas behind it really come from a long time ago,
Yeah.
when people thought there were people in the know, right? So you follow what the people in the know do, right? And that still happens now. And I think if I want to, if you want to have these sorts of rules about who to avoid on the social media and in the trading world, anybody that uses the word they,
Yeah.
right?
Yeah.
They're buying, they're selling, they are doing this. Who is the they? What do you think that all the investment banks and the hedge funds, the big hedge funds, are all working together? Do you think they're not competing? Do you think they take it in turns then? Today, Citadel going to move the market. Tomorrow, it's Goldman. I mean, this idea that they are manipulating at any one moment, yes, a trader might be trying to move this market down for a couple of seconds to execute an order or, do that, but that's literally for the effect of that disappears very quickly. But in terms of they moving this market this way or that, that's just depending on what's happening in markets, and it's really just a cop out, right?
Hmm.
It's usually a cop out for people that are losing. They go, oh yeah, well I was fine, but they did this. It's always and this leads into another discussion when people ask me about what was the effect of HFTs on your style, and didn't they kill your style, or didn't this and that. Again, these are all the bogeymen, right? In the old days on the floor, it was the locals. Whenever the guy on the phone for the bank or the broker, when they couldn't get an order executed well or something happened, they'd always blame the locals. Oh yeah, locals did this. They jumped in front. Locals were always the bogeyman. So there's this view. Oh, thank goodness, we've put the futures markets on screens. We've got rid of the locals.
Right.
Hey, isn't it great now? No, then there's a new bogeyman for why you're losing money and why you couldn't get the trade executed. Now it's the HFTs or it's the algos and it's this and it's that. There's always someone. And the reality, I always say be careful of people that talk about the they are doing things, because it's just the market is a whole bunch of different people making things, and that's part of that randomness that you mentioned and we've spoken about.
Yeah. Well, and to the like, who are the people in the know? Like, the thing that I my approach to that has always been, well, I should be the person that's in the know. Like, y'all can do what you want and you can try and follow what it's doing. I want to be the person that when you all think that it's going to do something and I knew something that the rest of the market overlooked, and I was able to take advantage of it, be on the other side. Like, you should be the person. Like, I think that a trader's job is to know as much about that market as possible, so that when the market is doing something dumb, that they can call them on it.
Yep. And part of trading is about having the information in front of you that enables you to make those decisions. Um, so how you're looking at information, what information you see, is important. Do you have, whether it's a watch list, or do you have a way of looking at information that will tell you that if what's happening in your market is
Right.
is out of line, is wrong, or whatever? That's really a really important part of trading. And again, with coming back to what's a form of technical analysis, if your form of analysis just incorporates what's happening in your market with no context for what's happening in other markets, to me that's just a form
Yeah.
of technical
Yeah.
analysis.
Yeah.
You're blindly looking at whether it's just a DOM of the order flow, and you're looking at just a past history of your market, and or whether it's using a chart and you're just looking at the past history. That to me again is an absolute simplification. And the way technical analysts get around it is because one of their other assumptions is everything's in the price.
Right.
It's a great assumption, right? Everything that's happening around the world and around it is in that price there. Well, I disagree with that, because sometimes you get different markets pricing in different things,
Yeah, it's
right? So that
empirically
can't be.
untrue. I mean,
Absolutely, absolutely. And then so that some order flow trading, if you're using a method that just looks about what's happening in your market, you're getting some of the picture, but you're missing the context of, well, yeah, well, people bought there, but based on the fact of what's happening. So with a market making style, that's a very much a part of it, is putting the picture together, understanding then, and about using how to use what's happening around you, and the fact that you have to use what's happening around you. Like if I came in this morning and I go through my watch list, first thing you do when you wake up, go
yeah,
through
yeah,
what's happening in different markets, right? You don't just look at it and go, right, oh yeah, ES Dow Jones is up X today, or that's it. It's, well, what's the whole picture? And you will get journalists simplifying the picture, sure, but they're not traders, but they'll say stocks were up today, and you'll see that the stock market might be up by 0.2%, and more stocks are down than up, for
Right.
example, and all that sort of stuff. So to simplify the markets in those sorts of ways is a
Yeah.
mistake.
Well,
So
again, I think that you're kind of saying like how is it more complicated? So like for instance, one of the things that I have is because I have a little indicator package, and one of like I think the most useful thing in there is an indicator that just synthetically calculates what the dollar index is based off of the spot FX futures. I'm like, how are you trading? You don't know how the currency that you're trading with is behaving right now. How do you make decisions when you don't even know what money is worth right now? Or if we're talking about equity indexes, it's not just like the E-mini is up or down. It's also like what did large caps do compared to small caps, and what sector rotations are there in there? Because it's so much more complicated than that. And I had to that point about watch lists. Trading platforms could put a lot more effort into their watch lists. I don't think that there's a platform with an
absolutely.
awesome watch list.
Agree with that. But actually, at the moment, so one of the other things I'm doing with the sites, say this gave me an opportunity to really rethink what we did, and so I'm also working with a couple of software people and people with products in that space to develop for them to develop their products better. And one of them, which that process is doing at the moment, is about is potentially going to be a really cool product for people to look at other markets um, and to get that information. I'd say I really took this point to step back and think, okay, what was all the information and all these things that I haven't done before in terms of working with software firms as well and people, with those sorts of products. So I've got a couple of things in that space that I think as well, hopefully are being worked on at the moment. And I'm not, I say I am not really getting involved other than consulting or
Right, right, right.
advising these people. Look, if you could do this, this would really help
Yeah,
day
yeah.
traders. And luckily, I've met some really cool people who have said, yeah, I'll do that. I'll build that. So again, hopefully I'll be, announcing in that on their regard, and that's for them. I say
Mm.
I have no affiliate deals with any of these people,
Right, right,
right?
right.
I just said you develop that and you sell your product. So I'm trying to work on those things. I agree with you 100%. So those are areas that I identified as well that I think there could be improvement in, and I think there's some products that are being developed in that way as well at the moment.
Oh, very good. Well, I'm excited. Well, so I really like talking about technical analysis, but there's some other things that we got to
Okay.
talk about. So there are micro treasury yield futures coming up next week, actually. And I think one of the most interesting things about this is that these are only going to be like $1 a tick. And so the margin requirements on these are going to be ridiculously low, which means that not only will retail traders in futures have much more opportunity to try like swing trades or trades over multiple days, but also trying to work out spreads. So I was wondering, like, what kind of advice would you give to people that are looking at starting to try and trade spreads in these new futures?
Um, I think in general, treasury products are more difficult for retail
Well,
traders to
that
trade.
I think that's definitely
Um,
true. Yeah.
so in general, I've always of the view that, no one forces any of us to trade a market.
Yep.
It's up to us to choose the one where we have most advantages. And my personal view is that when you're trading for yourself at home, you have more advantages trading against trading in markets where there's a higher percentage of retail traders and trading in markets such as equity indices where all the underlying market information is more readily available. Um, when you trade treasury products, you're trading against a cohort that's got a lot more professionals in it.
Right.
And when you decide to trade spreads, the same thing. There's a lot of very good professional spread traders and banks that have a lot more information, than we do at home, frankly. So whereas, I understand obviously the push to go to more micro futures.
Yeah.
Personally, I'm not a fan of small amounts, but I understand why exchanges are doing it of small tick sizes. I think any profitable trader wants the biggest tick size he can get, right? And generally, smaller tick sizes are developed for people that are not profitable. But of course,
Yeah.
the other point about from my speciality is is more, intraday short-term trades, and the very small tick size contracts don't allow you to do that, frankly.
Gotcha, gotcha.
You have to be a swing trader if you've only got, $1, $5
Right.
tick
Well,
sizes, right?
if you're like scalping, the
Yeah.
wider the spread is in the instrument, the more potential you have for profit.
Wider the spread and bigger the tick size, the
Right.
better it is for you. So, my concern, and this is always my concern. See, my view is, and I'm a huge fan and supporter of futures markets,
Hmm.
right? As opposed to, for example, FX trading platforms and CFD platforms, right? I really wish, like retail traders who get involved on those platforms, which a lot of the newbies get pushed onto FX and CFDs. I
Mm.
really wish they would understand the benefits of futures. And in fact, in my Blue Button course, I have a whole video about it, because I'm well aware that people may learn a bit and then go, oh yeah, but I can trade on a CFD platform with no commissions.
Yeah.
Why, and so I go through this process of explaining to people why that's a whole nonsense, right? So I love futures markets. I just feel that my issue with the small tick sizes with micros is just that it forces traders, retail traders, to more long-term trading strategies.
Yeah, I
Okay,
gotcha.
when you're paying $3, $4, $5, maybe
The,
more a
the
round trip
commission is
to
a
trade,
larger portion
the
of the,
commission
yeah.
is too large. Exactly. So it forces you to long-term trading. And my view is, and I think it's not just my view. I think that the evidence is there that the longer you try to hold trades for 2, 3 hours, 2, 3 days, you're going to struggle. So that's the whole one of the purposes of trading in my way is we're in and out within a few seconds. Is I just think it's far easier to work out what's happening over the next 2 seconds than over the next 2 hours. And
Mm.
I think that particularly with your own money, the longer it's in there, the longer you have exposure to the market, the longer you have the chances that something's going to pick you off, or something's going to, going to change in the context and going to get caught. So, I would rather that we in the futures industry promoted why futures are a better product, more transparent, more fairer, more honest, exchange cleared, and all those sorts of things. And we competed with CFDs and FX on those areas rather than compete with them because retail traders want to trade for $1 a
That
tick.
you can trade a smaller, yeah. So
Um,
I think there's a lot of truth to what you're saying. Like particularly when we talk about treasuries, I really like treasuries. So part of it is that that's just the thing that I like and I understand, right? Because for
yeah,
instance, oil is a market that moves a lot, and I have a lot of guys in my room that do really well with oil, but you know. I would have to learn a lot about that market, and I know a lot about the treasuries, and that's kind of where my advantage is. But you're right that like it's a very efficient market. The people that are trading it are really really good. So you have to be really really good, and there is a lot of information going on that you don't have because it's a future. There's people out there trading the actual cash bonds, and there's in the future there's like 10 different QSIPs that actually factor into this, and one is the cheapest to deliver. You can't see any of that information unless you have a Bloomberg terminal. So that definitely
exactly.
makes it difficult.
Mm,
There are some things that I still think are attractive to them. So there are some effects that with large instruments there tends to be more predictive signals simply because there's more order flow and more people trading in there, and particularly in the treasury market there are some inefficiencies that are well proven. For instance, forwards tend to overprice how much the interest rates can actually move during that time period is a really well established one that if you can figure out the basis difference and what the forwards are saying using data that is available, it's just not real time, that there are some edges. So I don't know. I'm going to try it and I'm going to see, we'll see if we can find an edge in there. Part of it is that until I have the ability to do the spreads and run some of my back testing and more quantitative things that I can learn how it actually works. So those are
yeah.
kind of some of the things that I find interesting about it. But the other thing that I find interesting about it is just the extra difficulties in managing two positions in two different instruments, you know. And if maybe you have a position that you're swinging and then you're trying to take out ticks with a second contract or something like that, how do
Yep.
you deal with that? And how do you deal with exiting a position when it's on two instruments and that sort of a thing? So those are sort of, can you speak to any of those kinds of issues?
Yeah, well, firstly, just to come back to your treasury. I mean, your analysis and what you're doing is firstly very different to what, just drawing trend lines and trading the general order flow, right?
Right, right.
And I do know some, obviously there's a lot of pro traders who are in that space as well, looking
Mm.
at the basis and looking at all these issues, right? And that's where there's something. But what the type of trading you describe is very different from order flow
Right,
trading.
right,
And
right,
I
right.
would say that, traditional, or what people call order flow trading, which to me is another form of TA, is going to be very difficult
Yeah, yeah.
in the treasury market. It's just not. So what you're doing is different. And also, the acknowledgement you made that there's information that you can't see,
Yep.
the cash bond market information. That's very important. Whereas obviously in equity markets, we can all see what the cash equities are doing.
Mm-hmm.
Um, but you're right in terms of the other information you do see, and the opportunity it does provide is, there are other contracts, 2 years, 3 years, 5 years, 30 years, and potentially it gives you opportunities that if, to be spreading in and out. And even if, one trade is not working well somewhere, it gives you actually, you've got more outs, right? Whereas if you've got a trade in an index and it's going wrong, you have one out to get out.
Right, right.
You have more than one out. Okay, you have the potential to spread if your market's just gone offered, but there is still a bit in the 30s or in the ultras. It does give you another potential as well. Yeah, in terms of that, that ability to trade, more than one contract at once, or all of those sorts of things. If you're spread trading, you're learning new skills, completely new skills. That like I just said, that
Mm-hmm.
ability to not just think about in terms of my P&L for my contract, but that, spreading into others, is great. That's giving you new options. And just as an aside, I'm actually going to do a series of webinars, for the stage 5 guys, and one of them
Mm-hmm.
is going to be about the transition from floor to screen, and talk about that in a lot more depth than probably has been done before. And one of the points that I'll make, which I'll flag with you here,
Mm-hmm.
is that there was some talk that floor traders all struggled, and I'll explain in the podcast why that wasn't true and why it's a bit of a misconception. But there were a breed of traders from the floor who absolutely improved and who loved going onto the screens, and they were the spread traders,
Mm.
because the information for them was a lot easier on a screen. See, on the floor, if you're trading out the reds and the greens and all those sorts of months, and you're trading, in the stir contracts, every few minutes you have to just keep asking what's there in green sep, and the green sep order guy might not be in the pit, and what's there in red June, and what's there. You had to keep working out what's there and working out. Whereas when you went onto the screen, it's all there for you in a beautiful matrix, right? So for and spread traders made the transition a lot easier. It was a very easy transition for them. Um, trading multiple contracts gives you a lot of opportunity in terms of spreading. And you've also got that opportunity more in another aspect of multiple contracts is increasing your trading size. You have that ability to do that when you're trading in treasury contracts and spread trading. You can go and trade up to, obviously much bigger sizes if that's the way you want. Whereas with our style, it's more about being nimble. So you generally don't trade, very many. You're trading a
I what you're
couple.
saying.
I have some ES traders, some clients of mine that will trade up to 20 lots or so. I think that's personally on the outside
Mm-hmm.
of where I would be comfortable. I don't think but that's more on the quiet days where it's just grinding a little bit, tick by tick. Okay, and then when it gets quicker, they might scale that back to twos and fives.
Yeah. I've done
And that's a
some
different process in
I've
itself.
I've done some analysis about, like, how big of can your size get before you're having an impact, and
Mm,
using some models from studies and so forth that you can kind of use to figure out like optimal sizing. And when I ran them on ES, I was really shocked at what I found, because it was basically like, if you were trading, like early in the morning, if you were trading 100 contracts, you were putting yourself at risk. It
yeah,
was a lot lower than I
absolutely.
thought it was going to be.
Yeah, absolutely. Yeah, yeah. I'm so for me, I think trading again. And again more from a smaller trader,
Hmm.
thinking about people at home, not just about their account size and the margin requirements, but I think I rate frequency as more powerful than size.
Sure. Okay.
So I think it's more important to find a method that will give you more trades per hour that you can trade in small size, and a style that will give you that you can trade up. And I get people to ask a lot about, well, what, maximum size and what trade size. I think they're asking the wrong question. I think frequency is more powerful, and I think if you look at most of the better hedge funds in the world, it's frequency that's what they're looking for. It's not always big trades.
Hmm.
It's frequency, and frequency plus edge, is, I think, more powerful than scaling up size. And you're using limited risk, but yeah. So I think people in that regard often asking the wrong questions. What's the maximum? I get asked a lot. Well, what's the maximum size I want to trade? I'm like, you're asking the wrong question.
Right, right, right.
You just want to make the most money you can. But I think people undervalue, people in the retail space often undervalue frequency.
Frequency. Yeah, that's okay. So that's a really good point. When I do my back testing, um, so I'm very weird about how I do the back testing because and I think a lot of this was from listening to you because I see so many people these days. There are a lot more people on the internet today claiming that they are making money from day trading than there was when I started in like 2017, right? When I started in 2017, the VIX was below 16, below 15 or whatever it was. There was like hardly any movement. It really sucked. Everybody that was trading said it was really, really hard. And, when they had a video contest for Futures IO, nobody wanted to do it except for me. And so they canceled the contest. And now it's like everybody's saying that they're doing it. But when I actually start probing and asking questions about, well, okay, like what's your average winner and what's your average loser and so on and so forth. And it's almost always like, the reason you're making money is because you're taking on risk. The market is paying you to take on risk. And because you're not
Yeah.
managing it, when the next big volatility event comes along, you're going to get destroyed. And so I
Yeah.
always like to backtest with like equal risk reward and try to reduce the amount of time that I'm in the trade, and have more trades is what really makes you more money rather than messing with, how many contracts and managing the number of contracts that you have or what the risk reward ratio is, because one, more trades really has a much bigger impact on how much money you make in the end, but also it gives you a better idea of, is the thing that I'm looking at actually matter? Because if you're trading like a 5-to-1 risk reward ratio, how do you know that signal, or even worse, your stop is larger than your target, right? How do you know that you're making money because it's a predictive signal and not because you just have a big stop?
Yeah. Yeah, I mean, again, you've made a number of points that I think are all spot on. And I did an interview with someone maybe a year and a half ago. I think it's probably the last or second last interview I did. I don't do many. So, and I made the point in there that a professional trader can spot another pro and spot an
Yeah.
amateur by the way he talks, by the way, the things that they say. And I know that that scared a couple of people in the industry. I had a couple of people say to me, "Oh, I guess you think that I'm not a real pro." And I was quite polite on the phone, but a couple of times I thought, "Yeah, you're not. You might be purporting and suggesting that you're a pro, but and you've got to the heart of some of it. It's not about how much money you make, right? And I'm not interested. Don't tell me about what your P&L was, and
Hmm.
don't tell me about what you made on a trade. Sometimes you'll look at something, a trade, and you'll just go, nah, that's just a crap trade. And we were doing work with my partner. So I work with a quant for the
Hmm.
for my fund and for my strategic trades.
Yep.
And a classic example was the XIV when that whole thing was
Mm.
kicking off, right? Which
Yeah.
is probably about the same time that you were talking about, right? You had all these XIV traders making a lot of money, and I read about a guy who went from 20 grand to 30 million,
Yeah.
over
Just
a few
come in
years,
short
right?
volatility.
But
Yeah.
yeah, we looked at the XIV, and we actually, and again, this is something that retail don't do. We looked at the prospectus of it. We went through it, and we came up with the conclusion: this product is not what they think it is. It isn't what they think. And eventually, the XIV blew up, and these people lost it. So, but whereas retail traders will look at the P&L and say, but even if he's had 2 or 3 years of this great P&L, it's a great trade.
Yeah.
I think pros will look at it and go, well, what's the actual, what's going on here? And not interested in the P&L aspect of it or the size of the fund or whatever. And, our view was from the start was this thing. And the only thing that happened was it blew up before we had a chance to create our strategies on it. But what I'm saying is that, yeah, the people's P&L out there and the way that they sell themselves, and I've actually got a plan to do my own YouTube video about how people sell courses and how people sell stuff to retail,
Hmm.
um, and how you need to look through certain metrics, and I think the XIV was a classic example of traders that they went from nothing to big and they thought they were great traders, but it was wrong the whole time. Their underlying assumption of what XIV was and what they were doing was wrong the whole time. It never made it right just because they made money. It was always wrong. And in this industry, you don't know whether you'll get 1 week doing that or whether you'll
Mm.
get 5 years. It
Right.
doesn't mean it was right because you had 5 years. Only if you had 5 years and got out at the top. And who does that?
Yeah.
Like,
So, so,
no one.
so when you see these sorts of things going on in the market, though, how do you deal with it? Like this GameStop thing is a great example.
Yeah.
I mean, like
Yeah.
orders move price, and they can keep price up there as long as the orders keep going, and it really has nothing to do with what the fundamental value of the company is, and it's really hard to watch that, even if you know what's going on, and not say, well, like maybe I can get something out of this here though before it blows up. So but I'm guessing that you're more prone to just keep doing your scalping and kind of ignore everybody. But I'm interested in like what goes through your mind when you're seeing those sorts of things.
Yeah, no, I'm a trader. I'm looking at those, thinking, what can I do there? What is there? What is their space? So, yeah, GameStop, so for me, my process is to come up with an idea. And the thing about market making is, even with the fund and the trades we structure for that, I still come I create those trades. We're not just design them
Hmm.
with back testing. I create those trades,
Right.
and very much with the market making aspect. So GameStop was one example. I'm like, okay, I came up with an idea of what I thought would be a good trade in GameStop options, right? I thought this is a crazy market. It was way too high. So the first stage is I just watch, and watch a couple of explorations of the options, see how they work. It turns out the trade idea that I had wasn't great. It didn't lose money. It was pretty flat P&L. So when GameStop was up here and then it plummeted, this trade ended up being flat P&L,
Right.
which is not the worst thing in a scenario, because it's very actually difficult to create a trade that had flat P&L in that environment.
Yeah. Yeah.
Everything either made or lost. But yeah, you try to, but often the opportunities are only there for a few weeks or months. So the way that we go about it, then to go and test it, by the time we've tested it, sometimes it's moved. It's difficult. I mean, as with those particular meme stocks, they're having implied vols at like 300 or 400%. I was looking
Yeah.
at one the other week. I think it might have been AMC. It was like 400%. Well, the model effectively doesn't work at that rate, right? So in Black-Scholes, you might as well just throw
Yeah.
darts at a board. Black-Scholes doesn't work properly at 400% implied vols. It's not supposed to happen. So you're really on your own there. So back testing is not really going to
Yeah.
work
Yeah.
either, because you're on your own.
Because
You don't
it's
have
it's
anything
so
to.
unique of a situation. You don't even have anything to compare it to. But the other thing that's going on though, and the thing that I think is unique about what I see in the current market compared to other markets that I've seen that is crazy, is just how much risk people can put on. Like especially when I look at the cryptocurrency markets, like some of the margin and the things, and it's like, well, yeah, if I'm willing to risk X amount of money, I probably would make money, but like is in the end, is it really worth taking that risk? Because you know that at some point that's going to stop and you're going to get stuck, and it only takes one time and you're screwed, right?
Absolutely. And yeah, watching the risk, that is a key thing. I was talking to a pro a couple of weeks ago. We were discussing this, and he was saying to me, 24/7, all I do is think about my risk.
Hmm.
And all I'm doing is thinking, all we're doing is trying to protect ourselves from blowing up. Those of us that are old school, he's an old school trader, all we're thinking about is how can I have a position that doesn't allow me to blow up, and we're always trying to work out what risk is. The risk that people take nowadays is incredible. And I made the point to him, the thing about markets nowadays is, like a 5% move now in a market, whether it's an index or crypto, is probably like a 20% move was 20 years
Yeah,
ago,
yeah,
because everyone's leveraged. And we saw vol funds a couple of years ago blow up on a 5% move in the ES. Like, if you're a volatility trader, and the XIV traders and some of these, it wasn't a massive move. It wasn't like a
yeah,
market crash that killed these guys. And you sit there and think, we're in a situation where a 5% move in equity markets blows up. We saw a hedge fund in Singapore this year, big, very much leveraged, blow up on, basically, a couple of moves in a couple of stocks or whatever. Those of us that are old school, it's like we spend our whole lives stopping. So to some degree, and one thing that, we both come to terms with is, for our own funds or what we do, is we're going to underperform in this environment. Yeah, absolutely. And actually, I was kind of in a conversation with my partner, who's a quant, yesterday, about, we've used virtually no leverage in our trades,
hmm,
and we're penalized because of it, because our performance is, not as good as others. I said, well, maybe we should go to two times leverage, like, it's which is nothing, right?
yeah, yeah, yeah.
But for us, it would, but things like this. And, in fact, the other thing I mentioned to him this morning was a trade idea that just hit me today, for these meme stocks, actually.
Hmm.
So, I'll be interested. So I just come up with ideas. We do want to try and play, but within the parameters that everybody has their own risk parameters. If it shocks me what people will take, and I agree with you, in crypto, often it's 15, 20 times leverage, which is why every time crypto falls, and it can be more than that. I heard in the two falls that there were earlier this year, like 1.5 million plus accounts.
Yeah.
Like, it's hundreds of thousands getting wiped all the time. Um, but people, yeah, they take risk that is just beyond us. But for me, it's not the first time I've seen this.
Hmm.
Maybe this is, the amount of leverage now is more than before. But if I go back in my history to 1998, 1999,
Hmm.
I see a very similar situation. Yeah, not with as much leverage, but retail traders massively outperforming pros by buying very risky stocks, the JDS Uniphases and all those sorts of stocks. They were getting involved, they're making good money, they're IPOing, they're flipping. Pros sitting there thinking, I can't play that game, I can't play that game, underperforming. Um, you know, I personally, I don't believe it can last, and I just don't want to play that game. And that's the
Hmm.
thing, is, as a trader, you sit there and go, do you want to play that game? I don't. So if they make money and they keep it, because as the old saying,
Yeah,
it's not
yeah,
about how much money you make, it's about how much money you keep. If they can make it and keep it, good luck to them. I'm not happy with that game. I won't play it. So
yeah. Ferengi rules of acquisition number one is once you have their money, don't give it back. Um, so I want to get into, and maybe well, so I have a couple of questions here about more current market situations. So first thing is, I'm really interested in a lot of the things that you've said about like the differences between the floor and modern markets. And I'm wondering if there was one thing that if you were like made the regulator, head of the SEC or the CFTC, and there was one rule that you could change, what would it be? What would you change?
um, the thing from a trading perspective right now, and I'll be a bit more broader than just, but in futures markets, I kind of wish they were all FIFO markets. Um,
What do you mean
and
by that?
there's a move in some, first in, first out,
Oh, okay,
rather than pro rata. So some
gotcha.
markets have changed to a combination. I understand why. But I just think you know where you stand if in a first in, first out market, rather than pro rata, which means if you're bigger, you can put bigger orders in and suddenly jump up. I'm not a fan of that, but I understand why they've done it.
Yeah.
But I'm just not a fan. From more of a regulator at the moment, there's a couple of things that I suppose irk me. One is the idea, well, one is the regulation of crypto. It kind of, the pump and dump aspect of it, which is clearly what's happening, right?
Yeah,
It,
yeah,
it clearly gets pumped
100%.
by people. Um, and that's linked to the second part, which is I think they're going to have to look at, when you're looking at social media, is people that put out trade ideas but say this is not a trade idea, and why
Yeah,
is it the case that, like, I'm regulated, that that there's a lot of costs involved in being regulated here, and anything I say, it has to be viewed in that way. And if you're talking in certain markets, or if you're working like in my situation, I'm regulated, and other people can just come in and say what they want and offer trading courses and things like that. They're not regulated, and it's now okay to do that. So where's the line here? Is why does it any investment bank or broker, why would you be regulated then? Why, and they have to be regulated in some ways, but if you're running an EV company, you can just pump anything you want to the moon.
yeah,
Um, these things are they're dangerous to me, and I think they're going to need to think a lot more about what is regulation. And either everybody gets regulated or no one gets regulated, in my view. It's just not fair that the situation right now, and the same with markets. If crypto is a market, if it's judged a market, it needs to be regulated like a market.
yeah, yeah.
And that includes all the KYC and all the other things, and the AML, and all the other things that have to be done. It has to be done. And if that's going to hurt crypto market that much, then there's a problem with the market.
Yeah. Well, it's because what you say very much applies to me and what I do. Um, and I'm sure that to a lot of people, like saying that would be really unpopular. But I think you have a really good point because, like, because I do the live stream, like I said, like I worked at a bank, but I didn't trade for them. I was just a technology guy, and everything that I've done has been on my own. And the only thing special about me is that I was the first guy that was dumb enough to live stream it. And so
Yeah.
I can tell people, like, I'm not recommending that you take a trade. I really don't want people to follow me. I kind of make it hard for people to try and follow my trades. I will, like, you'll notice I get a little bit quiet and I won't say anything, and then I'm in a trade. And if anybody was trying to follow that, they'd be like, "Oh, wait, what did you do? What?" Um,
Yeah.
but so I can do everything that I can to try and discourage that sort of a thing. But at the end of the day, I am putting out that I bought something, or I think that this is a good buy, or it's not a good buy. And as much as I can put a disclaimer that it's like I'm not making financial advice or anything like that,
Yeah.
the reality is that if I was on CNBC, I probably wouldn't be able to do it the way that I do. Like I don't think that I would be able to just show everybody my DOM and they could see everything that I was doing on live television. They might have problems with that, and
Mm.
I do think at some point, I don't know what the answer is, but I do think at some point there has to be, you know, some more regulation around this, because I'm seeing a lot of people coming out and saying, well, I think that this is a good trade or whatever. I'm not giving any advice, but, I think this is a
Yeah.
good trade. And then on the backside, they were doing the exact opposite. They're doing the exact
Yeah.
opposite. So, and it's not okay. And I might
No,
be responsible with it, but I know that a lot of people since then have, followed in my footsteps and have been much more popular with it. And they might not always be responsible.
Yep. And it's difficult because everybody's entitled to an opinion.
Mm,
Everybody. You don't have to be licensed to have an opinion on what you think of Tesla stock or what do you think
sure, sure.
of so and so. So that's where the line becomes difficult. But certainly, if you're selling trading courses, you should be regulated. Uh, if you are giving advice, that's the thing. Is, yeah, an opinion. I think this. I think Dogecoin is good. Right. That's an opinion, or I think Dogecoin is bad. But when you start, where does that cross the line with pumping, which is the difficulty?
Yeah,
And I
yeah.
think this is where we're caught out now. And the fact that in the past, if you or I or anybody here had an idea for ourselves, we didn't have a public forum to do it, like a Twitter, or
Yeah.
and if but the other point was that, generally, like, people, if I was running a big company, I wouldn't move into pumping Dogecoin,
Yeah, yeah.
right? But now that happens. So I think we need to look more about this, because people got hurt on that. A
Mm,
lot of people got hurt on things like Dogecoin, right? It's not make out by now. If an investment bank did that, there'd be an inquiry.
Yeah,
Let's
yeah,
face it. If an
yeah,
investment bank pumped that, and it turns out that they didn't agree with it, because that's isn't that what happened in the 90s, that they had buyer recommendations on stocks that they thought were crap. Let's face it, in the dot-com bubble, and we had an inquiry into it, and rightly so. That, and I, my book, as you know, in An End to the Bull, I talk about the sell side of the industry. We've got to be very skeptical of the sell side of the industry about them trying to sell us stuff. But if an investment bank did those things, they would be hauled before the coals. If someone who was regulated did that, so where does this? So I dump my regulation, I dump that, and suddenly I'm allowed to do what I want. I just think it needs to be looked at, because people are getting hurt, and that's the key thing. You just don't want people to get hurt on things. And of course, there's all the old DYOR, do your own research and blah 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 and all that. That's fine, and people are taking too much leverage, and there has to be consequences. I'm a big believer in consequences. If you choose to take too much leverage or whatever it is, you pay the
yeah.
consequences, right?
Mm.
Um, but it just seems like there's two different playing fields right now. That and I'm interested in this debate that's going on about whether to import this cryptocurrency regulation or whatever as part of the
Yeah, 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 yeah.
infrastructure bill. And I think that if crypto stays outside of regulation, I think you could see a lot more bigger players, because what does everybody wants a product that you can pump and dump to your heart's content and never get caught over.
Sure,
Seriously,
sure.
like, if that's the way it's going to go, I can tell you that's what's going to happen. If it doesn't get regulated, a lot of firms are going to look at that thing. So I can now pump and dump that to my heart's content, and it's not regulated. You're just asking for crooks to get involved.
Well, I think that they're
I just,
already, the fact that I can go out and create this cryptocurrency and say it's backed by dollars, and then not have to prove to anybody what it's actually backed by or where the money is and what happens if, there's a collapse, all is absolutely mind-bogglingly insane. And then, to make matters worse, companies are putting it on their balance sheet. It's like, that's not going to end
yeah,
well, guys.
it is a different world, and I just say that they're the things that I think that, and I know that they're struggling with it. I know they're trying to look at it.
Well, they want to be fair. They
But
want
for
to be
those of
fair.
us that try and do the yeah, for those of us that try and do the right thing, um, I just think that it kind of sometimes it just grates you that we have to go through all these hoops and hurdles and do all this stuff to make sure that we keep in regulation, that we have the right things, and other people just pump and dump to their heart's content something that is essentially another financial product of some kind. So, but I think generally there has to be an element, as I say, of consequences in this industry. That if people believe that they can make $1 million in 3 months on something, there has to be an element of, yeah, the person that's pumping that thing is clearly fraud,
Yeah.
but by the same token, did you really believe that? Like,
Yeah.
there has to be an element of people take consequences of their actions as well.
Yeah. Don't get me started on that, because I'll see mean things. But so I have a couple of other subjects that I want to get at. And the next one is now I know there's a CPI print tomorrow that's like a really big deal, and that probably negates anything that you might say now. But what is your current opinion about this argument on inflation, and the Federal Reserve saying it's probably transitory, and a lot of people saying, well, but what if it's not? But where do you kind of fall on that argument?
Yeah, I'm from a trading perspective, I'm trying not to, other than on the pricing in scenario,
Sure.
other than what were the markets pricing. So clearly, for example, treasuries weren't pricing in any kind of inflationary uptick. But the interesting thing is, even the last inflation print was reasonably high, and I think treasuries backed up for like 1 day or 2 days, and then
Hmm.
immediately,
Yeah.
just continued to grind. Look, I think we're clearly in a different scenario at the moment than they've been in for decades. Right, prices of goods are going up. Whether the rate, and of course with inflation, we're talking about the rate of change. Whether that
Hmm.
rate of change stays at these levels in 6 or 12 months, I'm not sure. I suspect that, though, that the prices of goods are not going down afterwards. And you're not going to get wages going back down afterwards.
Okay.
But when you have like the price of used cars going up 30 or 40% in a year, in next year, are they going to go up 30, 40%? I would doubt that. So the rate of change, I think, will slow. Um, but a lot depends as well about whether supply chains get back in. Look at the cost of shipping at the moment. It's clearly supply chain issues. A lot of this is
Yeah,
COVID and Delta
yes,
related,
definitely.
particularly now because Delta's affecting Asia more. I'm in Australia, but I would classify that in Asia in terms
Yeah,
of the way we've handled Delta. But if you look at Vietnam, China, and places like that that perhaps weren't as hugely affected a few months ago, are now going back into lockdowns and COVID. So supply chains are being hurt. So I don't think until we get out this side of this COVID, we're really going to figure out where we are. Um, all I say is, any given moment with a CPI print coming out, is if you're in treasuries, just work out, is this being priced in?
mm,
If CPI comes in at, a +5, +6, +7, whatever number, is this priced in? But even that, as I said, it's probably like a 1 day, for that, it gives you some help for that day. By the next day, recently, that's not been had much effect on treasuries for sure.
yeah, for sure. Tomorrow's going to be really interesting because
Mm.
some of that up move I think was just a stop run because we got the news reports of some big guys like going out when when the interest rates hit their low like last week. And I've been doing very well in the treasuries over the past week. Of course, I wouldn't say that it's very well on a risk adjusted basis, but just it's moving. It's been going well.
Yeah.
So I would think if the inflation is high tomorrow, that we might get more of a move than we were before. But uh, the market is still kind of like, I think even if it was really high tomorrow, I think the market still might say, well, we don't think it's going to last. So it's really interesting.
Yeah, I mean, they're off the highs now. It's not like it was a few days ago. You had a
Sure.
bit of a backup on Friday, so it's not quite where it was. It's not pricing in the same. But by the same token, I think some of it's just to do with the other actions in other treasury products and other markets. And um, to me, I've made the point that to me, treasuries for the last few months have traded like there's a structural short.
There's
I know that there's some funds have been, absolutely in short, but it's not. If you look at the data, it's not like it's been a massive short in treasuries.
mhm,
But there's certainly some funds that have been short and lost, but it's traded more like a structural short, i.e., that every day people are coming into that market, and it's like, I need to buy bonds.
yeah,
And whether it's I need to buy bonds so I can flip them and give them over to the Fed and get X basis points for them, whether for whatever reason. But you can just see a market like that just traded like a structural short. Like this is, if that's still there, but I suspect the Fed are going to start. Certainly, the hawks at the moment
yeah,
are
the
suggesting that
taper, yeah,
as early as things like that are going to change. And I think that in that respect, I think now is a time to sort of, okay, we've had this last few months where we've been in certain situations. We probably want to see now. I think that if that's going to be an environment where we're changing, then it's a time where the trades that have worked for the last few months may well not work going forward for the next couple of months. I think it's a time to sort of take some risk off the table in that sense, and let's see what the new environment looks like. And at the moment, we might be in that transition where some people are transitioning to that potential change. And then I think it's going to be a case of let's see how that affects it. Maybe it doesn't have much effect at all. Maybe it's just a small amount of
hmm
MBSs or whatever,
yeah,
but
yeah,
let's have a look at that. And I think it's a time to reevaluate again in the next couple of months.
yeah, very very good. So my next question was going to be, like because you said you started at a bank, and I'm interested for that guy because I'm 35. It's too late for me. I'm a retail trader, and I I enjoy doing that and I work it out. But if I was 19, I would be saying to the guy, if you really want to trade, you should think about going to an institution, like getting an education, going to university, and trying to get your start at least in some institutions. And since you kind of took that path, I'm wondering what sort of recommendations would you make for somebody that wants to get a trading job at a large institution? How would you go about doing that in modern markets?
Yeah, I think it's hard, but I was at a very different time.
Mm,
I was only 18 when I got that job originally, at a bank. I was the ticket writer on a
yeah,
trading desk,
yeah,
which is the lowest job, right, on the trading desk. But 6 months later, they gave me a trading book. That doesn't happen anymore. that kind of situation, that story. And the same, the floor was another way where, 17, 18, 19-year-olds could go down, be trained, and become traders. Those sorts of ways have gone. And that's partly with the new site. I'm trying to bring
Hmm.
back that way of teaching people, again, like the floor, to become like a local in the futures markets and trade for yourself. But the reality now is, like, for a lot of banks, they don't have many traders anymore.
Yeah.
um, they're just giving out their proprietary order flow systems to their clients, and orders just come in and orders get matched. So there's not many trading jobs in banks anymore. Hedge funds, like I said before, hedge funds, yeah, they technically have traders, but often they're just execution traders.
Yeah.
Or, there's the algo side of things. On the other side is a very different type of skill. And I would argue that, that there are a lot of, I work with hedge funds as well, and
Hmm.
help structure trades. I would argue that there's a fair number of hedge fund traders that still struggle with what I would consider to be basic trading techniques. That and whether that's try, maybe sometimes the way that they trade around positions and things. There's certain trading techniques that we grew up with, which I think really help us when we're position trading, that I just don't think that they can grasp that concept, because it's far more difficult to put into an algorithm.
Oh
um,
yeah. Oh, for sure.
so that element, it's a lot harder now. So to try to get a trading job in a large institution is actually a job where you're trading and you're able to learn the skills of being a trader.
Sure,
That's
for
what
sure,
you want as
for sure,
well.
for sure.
That's very
There's
difficult.
there's
I think
not
that's
there's
really difficult.
they got rid of all the prop desks is
Yeah.
basically, yeah.
Yeah, they all became hedge funds, right? And so there's very little of that around anymore, and that's, I think, why these skills, and that's why somebody said to me, like, what I'm doing or trying to do is create a legacy project, because these trading skills, which, they haven't diminished in value, right? And I've been able to transition from trading convertible bonds, to scalping futures, to an options market maker. I've not traded one market and in one way. I've traded a prop book of convertible bonds for a large investment bank, but the skill set that I learn as a market maker are the fundamental skill sets. And I liken this in the way that I teach, and to like a golf swing. It's like people will say things like, "Oh, if Jack Nicklaus was playing today, the modern players would kill him." Well, no, but he would have access to the modern clubs and the modern balls and all the rest of it. The key thing is about golf swing. The golf swing doesn't change in terms of the mechanics, right? You still need the golf club to hit the ball at a certain point, when it hits the ball. So the mechanics, you have to grow up and learn the mechanics of a golf swing. And if you have that, you can then go through the ages and apply that. And I think that that's what I sort of liken this skill set with. That the skills haven't diminished in value now in the modern. People say, "Oh, in the modern markets, do your skills still work?" It's not the point. There's math behind some of what I teach, and then there's real, and when I explain it, and in the book, sorry, not in the book, in the new courses, I give a lot more of the idea of the reasons behind why I develop these skills. I think that people will see that this must be true. If you buy in this way at this time, it must be better than buying at that way and that time.
Yeah.
And that's a statement of fact. But the problem is that these are the modern day traders, and a lot of the modern hedge fund traders, they just don't have these skill sets. So these skills are getting lost, and I just don't want them to be, because there's no reason why I should. I was, someone said to me, because I was 18, I'm sort of only 50 now. So
Yeah.
um, I'm still, all of my peers basically are in their 60s and 70s, right? And so too old for this. So I am like kind of one of the last of the Mohicans, right? One of the last people that, and I don't want these skills to be lost. They're good skills.
Mm.
They're like the fundamentals. And so, like, when I'm teaching people, I feel like I'm teaching people the fundamentals of a golf swing.
Yeah.
you know and that's why it can be transitioned to different markets, to different products in different ways. And like a golfer, once you have the mechanics, every golf swing looks different, which is why I can teach a number of people, their trading will look different. I did a YouTube interview with a scalping client of mine, um, and if you saw, that's John, if you
Yeah.
saw
Yeah.
his trading and my trading on a video, you would they look completely different, right? But the principles behind what he does are the same as the principles behind what we do. It, and it's a bit like if you looked at two different golfers. They could have two vastly different swings, but the mechanics of them are be the same. That club, when it hits the ball, is hitting it at the same, flat and all the same sorts of things, right? There's certain things about it. So those mechanics don't change. And yeah, I just really passionate about trying to keep that skill set alive, because it's still, and even with the hedge fund, when we have an issue where we're trying to work through something, and my first go-to is, what would a market maker do there? Let's
Yeah.
go through the market maker rules, the market maker things, and think, this is what I would do there. And the amount of times where we've gone back and tested that, it's been the way, is remarkable.
Yeah. One of the things that I hope, because I feel that the banks were put in a difficult position having to get rid of all their prop desks, because even if it's not a significant source of revenue, like there's a lot of expertise that you need,
Yeah.
especially when things go wrong. And I can only hope that there's enough kids out there just getting into markets now, maybe they're in high school, because there's a lot of them that are really interested in this GameStop thing, and my hope is that they learn some of these things, and that when the time comes, that there's at least a few people there at the bank that that know what's going on, so that things don't completely fall apart. But I think you have a good point. Like there really is, this information is hard to come by, and it's and not only is it hard to come by, but it takes a long time to understand. I'm every day there's making realizations about markets, things that I thought, like I'm realizing now the market is really very, very inefficient. I used to think that it was like, well, it's mostly efficient, and maybe if I'm lucky I can pull it. But no, actually the reality is the reason it's so hard is because the market is so inefficient to some extent. There's a lot of research that shows this. And I would never come to that conclusion, even when people are literally, like yourself, literally telling me every day when I'm reading stuff, they're saying it and playing it, and it still doesn't, dawn on you. And these are the sorts of skills that you have to develop. And I hope that they have it. So yeah, thank you very much. And it's also a soft spot for me, because I've always been, of the opinion the best teacher is the market, right? So we're always very careful about education. I've been contacted by lots of people about education, and I've always been like, well, I don't really, there's only one or two people out there, and I would add you to that list that are providing education that I think would actually be worth it. And even then, you kind of have to ask yourself if you have the money and you can really spend that. But these are skills that at some point I think are going to be pivotal for people. So
Yeah, one of the key skills that I think is being lost, which market makers have always been able to do, is the ability to trade against what's happening in the market at that moment. Is that sometimes you recognize that sentiment is changing or whatever, so people think out there at the moment. So for example, there's a lot of algos working this way, and what people think are HFT market makers is you front run. But when people think of market making, they think of front running, right? That you see
yeah.
where the big orders are and you jump in front. That is absolutely not market making. But I understand in the modern world, that's what a lot of people
No.
think. And there are HFTs that have been designed to kind of do that, just jump in front of orders. The real skill of a market maker is knowing when to run in front of an order and knowing when to fill an
Yeah.
order.
A lot of it is
That's
them pulling their orders when they see the flow, for sure.
Yeah, sometimes you'll see an order and you'll jump in front of it, and sometimes you'll see a big order and you'll fill it straight away. Yeah, you got them, right? And then knowing when to do that is the skill, and just generally being able to be a little bit contrarian, being able to see that there's something wrong. Now, the problem at the moment, well, not at the moment, but once risk management models started to come into banks, VAR model in particular, and variants of the VAR model,
Mm-hmm.
right, the value at risk model, essentially what happens in the industry, whether you're a bank or a hedge fund, and hedge funds have another import, which is they need to be keeping up with other hedge funds in order to attract money. Both of them together, if you put them together, end up with the fact that if you want to create a really big fund and get a lot of money into your fund, the only way you do that is by going with the current trend, so to speak. Not a great word, but the VAR model penalizes you if you
Yep.
have a trade that is against what's going on. So that creates a problem, which is another, coming back to the leverage. If you have a situation in markets where there's leverage and a situation where a lot of the big players are going to end up with the same position simply because that's the only way you can. If you want to grow to be a multi-billion-dollar fund, it's very hard to do that with contrarian positions. It's just too expensive. Um, then, and if you are a contrarian fund, that's, like, even if people that watch The Big Short know that how close people like Michael Burry were to having everything pulled from him
Yeah.
because he was being contrarian, right? It's very difficult to do that, right? It's very difficult. And so this industry has gone more towards, even professionals, towards an area where they're all trading in the same way. And I will continue to argue that if you have methods which are different to others, which I believe mine are, and you have that ability to be contrarian sometimes, that ability to be different, I think it's more robust. I think you're more likely to be able to see through the times where these people struggle, and even some of the best funds. You can have a look at, some of the biggest hedge funds, some of the best ones, when the markets fell, for example, COVID last year, when every time there's a market event where it drops, what
Mm.
happens to them? To me, that's a real sign of how strong you are.
Yeah.
And a lot of them lose truckloads of money, right? They lose huge percentages.
Yeah.
And so to me, even a lot of these professional and a lot of hedge funds, to me, their P&L just looks like leverage retail traders.
Yeah.
They make good money when the market goes up and sometimes leverage, and then when the market goes down, they all lose. Right now, that's something that those of us from the old school really spend all our time trying to avoid. We try to avoid that P&L profile of making money when the market's good and losing money when the market goes down. That, to me, that's a retail trader. That's what happens to them. So obviously, with our fund, we specialize in trying to create trades which have zero correlation to equities, which is very difficult. And at the same time, still try and have a reasonable return. And it's very difficult. And without my market making skills, frankly, I think it would be next to impossible. You
Right.
can't just do it through back testing. You can't,
Yeah.
because by definition, when markets have those events, what happened in the past
Yeah.
is out the
You're
window.
more interested in difficult to predict events, as Taleb would put it. It's
Just trying to create just trades that allow me to. We started off with the hedge fund trying to create trades which were kind of like hedge trades, but that didn't lose money when the market went up.
yeah.
Because you know that if in that situation, no one's going to invest in a hedge fund that just protects you from the downside, because that's once in every 10 years and the
Hmm.
market's small. So we kind of sort of flipped it. Say, how can I have the opposite position to everybody else, that when they lose, I can make, but by the same token, when they're winning, I'm winning small. Now, in theory, that sounds like it's impossible. And that's why it takes us sometimes like a year or more to really work on these trades. But I continue to think that if you want to survive and get through, you need different skills, And for me, I can only say what I do, and with the, whether it's I'm advising hedge funds or working on my own one, these skills that I developed through market making over the years, they're the skills, I continually come back to. It's usually one of those skills that helps me work out what the right thing to do at the moment is. And I guess to come back to golf, because it's very similar to like when I started playing golf, the way that retail traders approach trading, in that, I was started off being taught by my mate, right, who was a single handicap golfer. And so we'd go to the range and he would teach me, right? And he got me to, I was to about, 18 to 21, 22 handicap golfer, playing all right, right? And then
Hmm.
it fell apart. Suddenly I couldn't hit the ball, right?
Yeah.
And a lot of people start off trading because their mate gets them into trading and tells them about this thing, right, that he had. So it's a similar sort of environment. Then it fell apart. I go and see a pro. What does the pro do? He teaches me something to fix what had fallen apart, right? So he taught me that. Great. I learned this thing. He fixed what was wrong at that moment. I got back to my 18, 19 handicap, and then um, something went wrong again, right? And I'm back to seeing the pro who now fixes the new problem, right? And yeah, he fixed it. And okay, and this happened two or three times, which is, I think, and then what happened was, one day I had an epiphany. I don't know how. I'd watched something and I thought, I'm doing this wrong. What I need to do is to learn the mechanics of a golf swing and ball flight.
Mm.
Okay, if I'm hitting the ball left, why am I hitting the ball left? If I'm hitting the ball right, why am I hitting the ball right? If I'm hitting the ball low, what causes someone to hit the ball low? And so I went back to a pro and I said to him, just forget my swing for the moment. I want to learn all these things. So teach me the mechanics of what do I need to do? If my grip is like this, what would it have caused me to do? If my grip is like that, what would it cause me? If I'm, so from that, I learned the basics, the fundamentals of ball flight and a golf swing. And realistically, within 12 months, my handicap had gone back down to about 12 and was consistent there. And in fact, I was on the way to becoming a single handicap, single digits. And then I had kids, so I stopped playing a lot of golf. But the reality was that what he did was he taught me these mechanics. Now I haven't seen a golf pro since. I don't play golf very much.
Hmm.
But when I go out there now, I know the thing is it tells me the mechanics, and mechanics don't change. Yeah, the golf equipment's changed over time, just like a market changes from now to floor to screen. The equipment changes, but the mechanics of a golf swing don't, right? If I continue in a ball flight, if I stand in a certain way, I'm going to draw the ball. If I stand in a certain way, I'm going to fade the ball. If I'm doing something wrong, that's always going to be the case. The golf clubs can try and help me, but I learned the mechanics of the swing, and that doesn't change. The other thing that's important, and again, when I'm teaching traders, to teach them these processes and these mechanics, is when I'm on the golf course, if I start hooking the ball, I can correct it myself
Right.
because I know what could be. It could be one of these 3 or 4 things. So on the next shot, I might correct one of them. Okay, that didn't work. So on the next shot, I'll correct that. After 2 or 3, it's fine. And again, with my courses and those that have been on it know that I give a checklist and a process. If this happens to you when you're trading, it could be one of these 2 or 3 things. This is how you fix it. Whereas what most retail traders, so when I started playing golf, I had the wrong questions. I was asking the golf pro, fix my problem. And that's what he did. But then I just had another problem 6 months later.
Yeah.
And a lot of retail traders, similarly, they come in and they want to work. So this is work. So right now on GameStop, for example, analyzing options information on AMC or GameStop will help you on those days, right? Or trading GameStop and AMC on the days where they're doing well, you can come up with something, but that ain't going to help you in 12 months time.
Yeah.
Then you've got to go away and learn something new, right? You go and see the pro again and learn something new. You learn something new. Whereas my approach to it is, no, you learn the mechanics of how you structure a good trade, what it looks like, what the rules are for it, and then you learn to apply it. With golf, you have to learn, oh, it's windy today. So now I need to learn that I need to look at low ball flight. What do I have to do to hit the ball low because it's windy? And then you have to take into account those things. That's your job as a trader, is to use the skills that you've been taught and then apply that and learn what the conditions are on the day. That's the complexity. That's why some people will
Hmm.
struggle, because they struggle to adapt to the conditions. But that ability to have a problem and correct it straight away rather than go back to a pro. I know, oh shit, I'm leaking the ball left. Right. I need to, it's one of these 3 things. Now I know what the 3 things are. I can fix it myself. So that's how I think my approach to teaching traders is like that. Does that make sense?
Yeah.
And why I think retail traders do what I did initially with golf is just fix me right now and learn what's
Yeah.
right now.
Oh,
Doesn't help.
yeah. Like the thing that drives me crazy the most, like when people come into my stream, or just when I'm trying to talk to other retail traders, is this. There's this overwhelming attitude that, like, I want to know as little as possible. It's like, just tell me what the entry conditions are, and then I just do that one thing that I've been taught all the time, and it should work forever. And like you mentioned backtesting, I've gotten pretty okay at backtesting. I mean, my living is a programmer. It has some uses. I honestly, the thing that it helps you with the most is proving to you what doesn't work or what things are like, really actually really bad ideas.
Yep.
But you really have to actually understand what's going on. How does that market work? What is it that you're actually trading, and how does that thing function, and how does it interact with the businesses that trade it, and all of these things? Because if you don't understand, because what I've found through my backtesting is that you might find something that works for a period, but then the market changes and it doesn't work anymore. And like the whole question is, like, after the fact, I can go in and can say, oh, well, the reason that worked is because the Federal Reserve is just pumping a lot of money into the system, and that's why it worked. And then their tapering doesn't work anymore, and that's why. But if you actually understand the market, instead of just trying to run some pre-baked formula that's been given to you, then you have a chance at least of making the adjustment. Because what I've always found is I'll have periods where I do really, really well, and I'll have periods where I just do awful. Like last week, I think I had like one losing trade, and why was that? Well, because I understood what was going on. I understood that uh, this jobs report means that the Fed is going to taper and the market is adjusting that. So because I understood that situation, I can just, and the point times when I don't do well, it's usually because something's going on in the market that I didn't understand at that time. And so this attitude that some people have that like the less I can get away with not knowing, the better, I think is really, really harmful to people. And so I really like the approach that you're saying, which is like, I'm going to teach you how to structure a trade. I'm going to teach you how to come up with your own trades instead of trying to give you a trade. Because if I just gave you a trade, they'll probably do more harm in the long run than good, because what's going to happen is you're just going to completely flop all over and self-destruct when it stops working.
Exactly. And that's what I love about like clients like John in that YouTube interview, like the fact that he used what I taught him, but to develop it, and it looks completely different to mine. And I haven't got no problem. I love that. I love it when I've taught someone and they've taken what I've taught them and developed something that's unique to them, but based on the same principles. Like I said, like a golf swing, you can have a golf pro can teach 10 different people the same mechanics of a golf swing, but their golf swing is going to be very different.
Right.
But as long as the certain key things are right about it, then it's right. If my club head comes down and hits the ball at the right spot, I'm fine. How it got there, and so when I teach people, it's about that mechanics. And if you talk to golf pros now, for example, they'll tell you, like, a lot of people go to them. You go on YouTube, and obviously golf things pop up on my YouTube. The key thing that comes up is how to get more distance. Right, because right now that's the big thing in golf is golfers hitting the ball
Yeah,
a
really,
mile.
really
So
far.
you've
Yeah.
got all these retail golfers, all these amateur golfers. Just go to golf pros and say, "I want to hit the ball longer. How do I get more distance?" Like, it's the wrong question. Like, when you look at the scorecard, if whatever type of golf you're playing, right, whether it's a Stapleford point system, whether it's about how many strokes you take. There's no points for extra points for the distance you get, right? And so what I find, in the golf thing is that right now it's all about that, and in 3 years' time it might be all about something completely different. But right now they want extra distance. And you go to them and they hit the ball along and they hit the ball a mile and end up in the trees. And then you go, right, now can you play the ball? You're gonna have to play a sort of left to right shot. Can you do that? I haven't got a clue how to do that. But exactly, you don't. If you understood the mechanics of a golf swing, it's fine to be a long driver,
Yeah,
but you
yeah,
need
yeah.
to have the rest of the game as well. But right now, the trick is teach me how to be long. They're not thinking about how does being long get me around the golf course sometimes, and so for us, and for a pro golfer, it's, yeah, look, being long, but also it's course management. On this hole, it's not about being long. On this hole, it's about being in the middle of the fairway. On this hole, it's about being and course management, and trading is about position management and risk management as well. But also that understanding of all the other points is that I can't just get around a golf course just hitting the ball long. But I say it's the wrong question to go to a pro and say I want to be longer. It's kind of like,
Yeah.
make me money in this market. It's like, yeah, you don't. You're right. You don't help people by doing that. You help people by explaining this is the mechanics of a golf swing. If you can do this, you'll hit the ball longer. If you do this, you'll hit the ball left to right. If you did, and by that, then it's your job as a trader and as a golfer to put that together and come up with something that suits you. Like, it doesn't suit my swing and my style to try and smash the ball as hard as I can and go for 350 yards. Right? I know that, so I don't try.
Yeah, yeah,
Right?
yeah.
But we understand the differences. I say for traders, it's a similar thing. Understand a lot of people going into trading, like I said at the start with the Yellow Jacket course, the way we've slowed people down with that is that to say, no, we need to slow you down and we need to get you to the right questions in the right way. Firstly, through knowledge, and understanding of the basics of this product, and then secondly through understanding the very basic mechanics of a trade. If you get a trade in this way and this way, it's a better trade than doing it in that way, irrespective of market conditions. If you do a trade this way and you get filled in this way, in this kind, it's a better trade in any market condition than compared to X to compared to Y. no use of levels, no use of what happened before, just being in the now. Same thing in golf, right? Yesterday I came to this hole and I played an 8 iron on this par three. Does that mean you hit it again today? Well, it depends on what the conditions are today. A golfer that traded based on yesterday's conditions is going to be rubbish.
Mm,
Okay, it's a generalization. Same for us. So you come back today, today the wind's in a different direction, I got to take a different club. And a lot of retail traders, and I say use golf a lot in analogies when I'm teaching people, but a lot of retail traders essentially say, right, so an 8 iron's 150 yards, right? So every time I got 150 yards, I want an 8 iron.
right.
That's how a retail trader
Yeah.
approach trading. Every time this happens, I do this. And it's like, well, no, because if the wind's in your face, you might need a 7 iron.
Yeah.
Or if the wind's behind, you might need a 9. But that's more complex to teach, right? So a lot of retail traders don't like that thing. No, no, no. I want to know what I
Well,
use at
not
150
just
yards.
complex to teach, but I think a lot of this information is really tedious. Like the things that I'm learning about treasuries and the yield curve, it's boring stuff. It's calculus and stuff. Like not many people want
Absolutely.
to read that. Um,
No.
well, I.
And that's where the edge is,
Yeah.
right? If you're prepared to do that hard work and to think, no, I'm prepared to also to drill down into far more detail. So, on my checklist when you're trade, there's like 6, 7 things right now that could be wrong or could be, and it's at the moment you're filled, them as well. Whereas most people just say things like, I bought 15s and I lost money, so 15s is a bad place to buy. Like seriously, that's one of about 7 or 8 things that could be wrong with that
Sure,
trade,
sure, sure.
right? But if that's all you want to know, then fine. But you've got such a simplistic form of trading, and I just reading. I don't really read many trading books, and
Hmm.
I generally read books from other things. I'm just reading Josh Whiteskin's book, The Art of Learning, and I'm really getting into Josh Whiteskin.
Oh,
I think
sure,
he's,
sure.
someone who's been able to transfer, his not just talents, but skill set into different areas. From chess now to martial arts. And he says how what an amateur will see as like one move in his martial arts sort of way, the professional like he has broken it down into like multiple fewer multiple more frames. Like you think you see a 1 second move, and that's actually broken down like into maybe 20 different parts. And that's the difference between like working at an elite level in something. And I think it's the same in a lot of sports. So even with my golf thing, I know a few things about a golf swing, but a professional will break it down into even more detail than me.
Yeah.
And that's the same with my trading. It's like with this form of market making, scalping, we break it down into some very small details. This little thing is important, but that's a professional approach. That's how you get to becoming to be at that different level. But if you just want to say, yeah, I bought 14s and I lost, therefore I'm not buying 14s again. Well, good luck. But
Yeah.
you know
Yeah,
that's
the weirdest thing that I ever found from backtesting was that they didn't like to pivot on 13. Well, but maybe that was just random. But people definitely do think like that, and it's like complete nonsense. Of course, it didn't help you make money trying to incorporate it into a trade, but I don't know. So funny. Um,
yeah, no, absolutely.
so I had two other thoughts. So to that point, because one of the questions I had on here was recommended books. It sounds like you're kind of saying, a lot of the things that might help you the most are going to be books that aren't even necessarily about trading, but are more about developing processes and performing well. Yeah.
Yeah, and so the last few years in particular, I've worked with ex-professional sports people, but also people from professional aspects in industry as well. And I think basically I used to review trading books for a
Oh yeah.
magazine, and quite frankly, 99% of the trading books were rubbish, and I got sacked from that job, right? Because and I told them I'm going to be honest about these books, right? And I just kept, and they were big authors. Some of them are well known.
Hmm.
Mainly, most trading books are technical analysis type
Yeah.
books, but and I was just coming back saying this is garbage, and I would just point out page 37 says this, page 68 says that. They're completely opposite. And so eventually I got sacked from that unpaid job of reviewing books. So I'm interested in cross um, skill sets, and there's of course there's differences between some sports and us, right? That some sports are finite games. This is where a lot of the other interesting topic is psychology, right? I think there's a lot of pseudo psychology in trading as
Yeah.
well, and stuff about you got to have a winning mindset or things like that, or mindset on, oh yeah, this trader struggled, but as a kid, this happened to him. I'm like, seriously, like that's nonsense. Um, because finite games. So, for example, playing chess. Reading Josh White's skin of really interesting books about some of his processes. But playing chess is very different, right? You against someone else. It's a finite game, right? You can influence him. He can influence you. It's a different game. So the skill set available, and a lot of sports are like that. So we can learn some things, and there's some elements to what we do that are similar, but there's some elements to our game and the psychology of our game which is different,
Mm.
and we have to be aware of that. And I think in a lot of the pseudo psychology in trading right now, basically people that don't really understand trading and just sort of say it's all about psychology. But frankly, no, if I have a shitty a trading tool, and sorry if YouTube will take that out, but if I have a really bad trading tool, let's say my trading tool is based on the performance of my football team. If Liverpool win, I buy the S&P, and if they lose, I sell the S&P, right? Okay,
Yeah,
now
yeah.
that trading tool says that, but it's clearly my psychology is irrelevant there, right? And I can say, oh, I'm losing mine. They can say, well, yeah, it's because no, it's the process. So I often think that if you talk about professional athletes, it's the process. So I'm interested in processes. So I love the books by Matthew Syed, which again look at how professional athletes, but also um, organizations will work. I think we can learn a lot from that. And it turns out when I reflect them back to the way that I try and have processes in the course, they're very similar. The other thing that I've introduced is OODA loops, which I wasn't aware of, but I trained someone who's former military, right?
Mm.
And a pilot. And he said when I taught him, he said your process for reevaluating trades, right? This process, he said, is an OODA loop, and I didn't know what an OODA loop was. So I researched it. It turns out it's a very powerful, it's a loop, obviously, a very powerful mechanism process for reevaluating fast time. So it was developed for military, for fighter pilots, because they have to make decisions really quickly. And it was worked out that this process will allow you to make decisions quicker and better than the opponents. And the Americans who had struggling in one of the wars, I think maybe the Korean War, at
Mm.
the start of the war, they were losing lots of fighter jets. They had to work out what was happening, getting shot down, and OODA loop. So he said to me, your process is an OODA loop. So that really got me interested again in that thing. And it turns out, yeah, I was really happy that I developed this OODA loop style for trading. So yeah, I'm looking a lot more into books about, and I'll be doing a lot of this in the course, in the community version
Okay.
of my
Okay.
new course, about and hopefully trying to bring on some other people from other professions and other tasks to talk about how they incorporate some of these aspects. But again, all about it is what we have to understand is we can't, we're not in a finite game. We're in an infinite game. We're not playing against other people as such. It's not we win, they lose. So it's all the time,
It's
right?
true. Right. It's a zero
We're
sum
playing a
game, but it's kind of also not, because like I was saying
no.
earlier, having other locals that know what they're doing in some ways is an advantage to you, especially if you know them and you're talking to them,
Yes,
you know?
because we need them to help us, right? We need. They do help us to make decisions. And of course, whenever you're trying to work out what the value is, you need to understand who are the people I'm following. I need to find out something that tells me where value is. So you do need some good people. But as I say, when playing chess and even poker, I like to play poker, and I'll bring some poker analogies in as well at times, and I may even bring a couple of pro poker people that I've taught into the new community. But you have to understand, on a poker table, it's a different dynamic. I affect how they play, and they affect how I play, and my interactions with them in the past, and we see each other, so affects each other. So it's a different psychology aspect to trading. So I have to be aware that there's some things in poker that are similar, but there are some things that are different. So we don't know who we're trading against. So the fact that I've just skimmed this little guy, and that's what I'm trying to do, right? I'm always trying to trade against the little guys. The fact that I just
Hmm.
skimmed him for a couple of ticks, he doesn't even know about it. And that's one of the beauties about this style. I'm taking only a tick or two off him. Half the time, he's actually quite happy to give up a tick or two anyway, right? That's just slippage or whatever it is. So he doesn't
Right.
even know I've fleeced him for $20, right? So it's there's no actual competing psychology there of he's really unhappy that I just screamed him for $20. He's quite relaxed to give that away because he's trading for a lot longer term. That's just part of the slippage that he expects. So that psychological aspect is I haven't damaged him by making money off him. That's what I love even more about this style. I'm aiming for these little guys, and I'm taking money that they don't even know about. Um, so that's why, again, it's still available tomorrow and the next day. But in poker, it's different, right? If I take money off this guy opposite me on a poker table and I've just cleaned him out or whatever, and he's now reloaded, we've got that history between us now. So that's why you can't compare the psychology of all this. The same in chess.
Mm.
If you've just beaten someone in a chess game, you've got that psychology. So I'm really interested in these sorts of aspects of using some skill sets from other areas as well, because they have some good skills, but also understanding that our game is a bit different. It's an infinite game.
Sure. Yeah. If you ever find yourself available when I'm streaming and you happen to come by my stream, it would be because I have this argument with my stream a lot, actually, because a lot of people want to say, well, you just need to develop the right psychology, as though, like, if you have the right attitude, then you can self-actualize the profits or something like that. And I'm always telling them, like, you can have the greatest psychology in the world, and if you have no edge, it means nothing, you know? And
100%. I think this psychology thing, and it's something that so I spent a number of years debunking technical analysis, and I'm sure you've told your people, but I have a free ebook that it explains to
yeah,
people
yeah,
all
yeah.
that I've done. I am planning to do similar with the pseudo psychology in trading. I 100% agree with you. Have you ever come across a trader who's come into the market, put money into an account, and says, I want to lose?
No.
Reality, everybody says they come in with a winning mindset, right? Everybody
Yeah.
comes in wanting to make money on a trade. As I said, I can come in with the great mindset in golf, right? But if my golf swing is rubbish, right, and the mechanics of that golf swing are incorrect, and I'm always hitting the ball with the wrong part of the club, it doesn't matter what my mindset is. The mindset is something I think of in sport, for example, at only an elite level, that
Yeah. Yeah.
sometimes you're
Yeah.
going to need a
Exactly.
psychologist coach, right? But for the most people and for retail traders, it's not your mindset holding you back. You're using rubbish tools, right? You're using the wrong indicators, and you could have the best mindset in it. I 100% agree with you, and I think that yeah, I've got a lot of thoughts, and like, we could do a whole
Yeah,
new
yeah, yeah.
chat about
That's always like,
this
come and
psychology
do
of.
it when we're going live, and because I don't know if I can do justice to, because some of these guys do have some good points on it, so I don't know if I would do it justice, but because I can't convince them. But it's just like the technical analysis thing. I've been going this whole week on TikTok about technical analysis. So I'm really excited about some of these things I've been learning about the inelastic market theory. I would really highly recommend reading into those studies, because I think it backs up a lot of the things that you have said in a very empirical way that, or I think, really drastically changes the way we should look at markets. Eh, they don't believe it, because I don't know. I don't know how do you make these points and make them convincing to people, because our people that you're
Yeah.
really trying to reach, they understand it, and they immediately go, oh, okay, this,
Mm.
I understand why this makes sense, because I can prove that is a better place to buy,
Yeah.
whereas this other thing, you're making this big structure up of something that I really can't prove that that's actually what it is, and actually when everybody tries to prove it, they can't, you know
Yeah.
uh, but
I think that's
they don't believe it.
yeah. You make a good point. I think that's one reason why a lot of professional traders keep away from the retail industry. Don't even try, And I had this sort of love hate thing, right? So I do engage with retail traders, but not a lot. Like, you don't see, I don't do a lot of webinars or discussions like this, right? I do very
Yeah, yeah,
few,
yeah.
and I write the odd book. I do some things. I don't tweet a lot. I don't. I get involved to some point, but I find that a lot of times you're right, that people don't want to hear it. Now, I first wrote that book. It was published in 2000. Technical analysis in the active trader was first
Hmm.
published in 2005 or whatever it was, right? And I've put all these views on technical analysis and said to people, tell me why I'm wrong. And here are all
Mm.
these studies and all these other things on it, and tell
Yeah,
me
yeah.
why I'm wrong. In all these years, 15 years, no one's ever come back with a valid argument. Yet, people will still criticize my view and say, oh, yeah, but you're just closed to technical analysis. You don't even open your
Yeah.
eyes to it. I'm like, but but it's factually incorrect. Now it's like proven. And
Yeah,
it's
exactly.
very
Because
difficult.
they'll try and if you have a really good argument and you have the evidence, then what they try and
Yeah,
do is they bargain with you. So they try and say, well, maybe technical analysis is useful when you combine it with X, Y, Z sort of a thing,
absolutely,
and it's
exactly.
kind of
Yep.
like, well, like you're trying to say you can minimize your risk with doing this, but how do you know that it's only going to move 4 ticks or 32 ticks at this time? You don't know that. The
Uh,
like
and it's right. And the other point that they come up with now, which is really interesting now, and I've caught a couple of them out on this because I'm old enough to have been around, like,
Yeah, yeah,
and learn from technical. And I did do two technical. I learned from two of the at the time in
yeah.
the early 90s, two of the leading, probably one of the most well-known guys in Europe and one of the most well-known guys in the US. I did personal courses with them to learn it. I needed to learn it. But
Hmm.
nowadays, what they say a lot of the time is, oh yeah, but there's so many people use technical analysis in these levels that you need to be aware of them, right? That they have an impact on the market because there's so many. Effectively, that argument is it's a self-fulfilling prophecy, that because so many people are buying at that level, that level now becomes important. Now, the interesting point there is that all of the early technical analysts and the people that were there at the beginning will tell you that that is absolutely not the reason why it would work,
Yeah.
right? That they refuted that allegation strongly, right? That the
It's
idea that it
it's
would
it
only
wasn't
work
the
because it was
basis of their
self-fulfilling.
theory.
Absolutely. But nowadays, what's interesting, you have some technical analysts out there that make that argument. That the reason why you should use it is because there's lots of people using it. And they don't even understand that that completely destroys the whole case for technical analysis. The
Yeah.
idea that it's reading psychology and reading the market sentiment. They don't even know that. And just to finish on that, on this topic, to intertwine it with the psychology, what I find is very interesting, a lot of the pseudo psychologists out there are also people that use technical analysis.
Yeah,
I
yeah, yeah.
find that interesting for two reasons. Number one is because when you study, for example, behavioral finance, and some of these people claim that they're using behavioral finance in their, in their psychology. But when you study behavioral finance, one of the first of the heuristics and shortcuts that you learn is the representative bias, which is using patterns, and this happened in this before, so it will happen again. That
Yeah.
kind of pattern connection. That's exactly what these traders are using. So, in my opinion, you can't have studied behavioral finance and use technical analysis because you're told that that's a shortcut. And the second point that I find is interesting is that to link the psychology with TA is that, in my opinion, that technical analysis, and the studies show this, is a very much like a random form of trading, right? That
Yeah.
if there's a chart pattern forms, right? So the head and shoulders pattern, which I refer to in the book, in the technical analysis exposed, been studied, and it comes up with a success rate of around about 50%, right? And I think most patterns will be similar, and there's a lot of indicators around that sort of level. If you're using something like that, you are you do have more of a psychological problem coming because you use this pattern, you lose money. What can you do now to change that? What
Yeah.
can you do to improve? Nothing. You just got to go and do it again.
When
So
the
this is
market
where
regime changes, there's nothing you can do. You just
nothing.
have to go and find another trade.
Yeah. So you either keep doing it because you've got this other psychology. You've done this pattern, you've done it 3, 4 times in a row, and you've lost money every time. Now what happens? Because your psychology now is, well, if I change, I bet you the next one is a winning one, right? This is where psychology. This is why these people have psychological problems, and why psychology. I think these these people talk about psychology more because the methods they're using puts them into some really difficult psychological positions.
Yeah.
So you've used this indicator 5 times, you've lost. What happens now? Because you've back tested it or someone's told you it works. So now the sixth time you think, I got to do it again, and I got to do it again, and then you've done it 10 times, or it might even only be 5 or 6. But the point is that you're worried that if you switch to something else, that you now think it doesn't work, or the next time is bound to be the time I win. It's a bit like changing lottery numbers, right? People that do that, they're scared about changing numbers, so that's difficult. You've got that process where you've lost money on something, but you just got to go and do it again because
Yeah.
the
Yeah.
chart pattern, right? The rules of a chart pattern don't change, so you just got to go and do it again and you lose again. Well, that's a very difficult psychology. Whereas what I'm saying is, like with my process, is a process. that when you lose money on a trade, what happened? Find out what the weakness was and fix it.
Yeah.
The psychology is very different then. We don't just go and do it again and do it again and do it again. I don't, and I've got to get back on the horse. And a lot of the psychological problems they have is because they're using a method where they can't improve, or they're just forced to do it again and again. And again, come back to a golfer. Golfer hooks the ball left on a hole. He's not just going to go and swing again the next shot and do it again and hope it's okay. He's got to figure out, why did I hook it, and fix it. That's the professional process, and that's not about psychology. It's about your process and about knowing how to fix it. And that's where I think, and of course, sorry, just coming back to the third, another point I should make is this, and on a psychology and TA, is when you're using those patterns and indicators, is random rewards, right?
Yep.
Sometimes
Yep.
you win, sometimes you lose. Random rewards are addictive. You end up playing that addictive game. And that is and again, why people
So
tell
yeah.
me that they're psychology experts and they're trading psychology coaches, if they use technical analysis, to me that blows that story apart, right? Because to me, I'm just saying, but you're using something that gives you random rewards. One day it will win, one
Yeah.
day it will
How do you
lose.
know that? Yeah.
I, I don't want that. I don't want to just go on a golf course, hit a ball, and sometimes it goes left, sometimes right, sometimes straight, but hopefully over time, most of them go down the middle. I want to find out, why did it go right? What do I need to do to fix it so the next time I can improve? And by doing that, I'm taking that random rewards out of it, and I'm saying it's about my skills. It's, do I have the skills to fix this in this market condition? And that's why I don't think it's as much about psychology. I think it's about having the tools and the processes to make those adjustments. And that's what I try and do. And that's what, and I know that I'm not going to win 100% of the time. A golfer knows he's not going to hit 100% of fairways, because we're humans and we make mistakes sometimes, or the conditions change at that moment, or something happens, right? All we can do is learn from it and move on. But we tried it. We tried it. I don't just try to hit a 50%, 55% success rate and say that's a little bit of edge. I'm saying, can I improve? Can I improve? I don't want to be chasing random rewards. So that, but I'd say we could talk for ages. I think some
Oh
very
yeah.
interesting topics.
So
But
I was gonna say that this format is really great because you're saying so many great things, and I think that this kind of like interview format, you've really excelled in it. But we're coming up on 2.5 hours, and I think we should keep talking, but we'll probably have to cut it off for the video. When is the course going to go public?
1st of September.
1st of September. So 1st of September, and we'll have the video out shortly before that. I'm really excited to see that. And we'll end the video here. Anybody that made it this far, congratulations.
You're well done.